surveys, if you look at the messages we get for the bank lending survey, for instance, it is consistent with a slide into recession within the next 3 to 6 months. So that's not really changed. What has changed is that you alluded to this. There was this one lower than expected print for inflation in the US. Market scrambles, depricing what it expects on the Fed. The expected rate differential for the next 6 months between the ECB and the Fed shrinks, and voila, you've got a euro rebounding. I would not read much more than that actually into the rebound of the euro. For me, it's an interest rate differential play. That's it.
So, Gilles, walk us through your assessment of the inflation backdrop right now and how you think this bleeds into 2023.
Well, I know especially 2-3 months ago, it was very unpopular to still use the word transitory because it was a very persistent form of transitory. But it's what we were expecting, that we would see some deceleration in inflation towards the end of 22 and into 2023. The question is how quickly we will get closer to the kind of target as central banks are pursuing. And that's a different question from the fact that it is probably already starting to decelerate. So in the US, it's definitely a labor market issue, and for now, let's say that the data is ambiguous. Our contention is that we will see a slowdown in wages, and that will help take core inflation down by the second half of 2023, even if the first month of next year are going to be tough. But it's a sort of traditional, usual macroeconomic behavior. And you've had a very, very tense labor market. Labor market needs to soften, wages go down, inflation go down. In Europe, it's much more complicated because you still have a very, very significant share of our inflation, which is completely exogenous, which is completely driven by external factors, the depreciation in the euro that we've had until very, very recently, and gas prices, which remain extraordinarily volatile. We also expect a slowdown in inflation next year in Europe, based on mechanical behaviors, the fact that base effects should play in the right direction in 2023, but it's much harder to assess simply because it is not the usual traditional behavior of macroeconomic patterns. We are completely dependent on where gas prices are going to be in 6 months' time, and we've been disappointed before. But on the basis of what we know right now, on the basis of forward gas prices, for instance, we should see deceleration in inflation in 23 as well in Europe.
So, Gilles, just to sort of put that all together, are you basically saying you're willing to push against the stagflation case in the United States, but that Europe looks much more likely to be mired in stagflationary types of environments for a longer period of time?
Yeah, for me, a key difference between the US and Europe is that to some extent, the US, especially the Fed, is to a large extent in control of the situation. If the economy tanks in 2023 and normally inflation goes down more harshly than what the market is currently expecting, then the Fed can actually slow down its pace of tightening and even cut rates. So there's a measure of control, if you want, on the state of the economy in the US. In Europe, we don't have that level of control because it is not in our hands. And for all the activism of the ECB, the fact that it's talking about a lot, that it's acting, it is normalizing its monetary policy. Truth is, and they've acknowledged it themselves, they have very, very little impact, and they know it, on inflation in 23 in Europe. So yes, on the basis of the balance of risks, we have more downside risks in Europe than in the US, I think, or to be more precise, we have less capacity in Europe to get us out of a recession in 23. And that, I think, should remain reflected in our exchange rate. And for now, we have this sort of knee-jerk reaction to this low October inflation print in the US. I hope it continues, but we've had accidents before. But fundamentally, the problem is that Europe doesn't look as in control.
It just makes me wonder, when you're doing your year ahead outlook, if you basically have meteorologists there, several of them showing you satellite pictures of what the weather is going to be like and what the trends are of El Nino or La Nina, just in general to get a better sense. Gilles, you're saying that there isn't much that Europe can do. Is there anything that you are looking for, maybe not this year, but next year, to determine whether they've gotten a little bit more control over the energy situation so that they're not just susceptible to the next LNG import?
There's well, LNG imports is still the key, in the sense that what we need to see in 23 is the emergence of LNG importing capacity in Germany. As you know, at the moment, you have LNG importing capacity in Italy, in France, in Belgium, etc., etc. You don't have it in Germany. They have a project to have a terminal coming out in 2023. That needs to come out. We need to have this LNG capacity in Germany to make us sure that 23-24 is not going to be a replication of what we're going through right now. So that would be definitely positive. Another point, which is probably less discussed, is the capacity of the French nuclear power generation to really reach its potential in 23. That adds actually to the difficulties we have right now. As you know, you've got lots of nuclear power stations in France which have not restarted. There's a plan to restart them gradually over the next few months. We need to see that plan complete by the end of this winter, again, to give us a measure of comfort in terms of electricity generation for 23. So that is less discussed, but I think it's almost as important.
Gilles, wonderful to hear from you, sir. A bit of a reality check around the European story from Gilles Moak there of AXA Investment Managers. I remember having the conversation several months ago with Maria Tadeo. I think it was on this programme. We both said it's going to come down to the weather. I never thought I would see red headlines across the Bloomberg on the weather. Milder winters helping the European story, and in some places the market moving on it, and that's what we've seen over the last month or so.
Okay, contrarian viewpoint.
Please.
There might be redheads for the U.S. winter as well, particularly with diesel prices, because diesel prices are still near record highs.
You're very focused on this, aren't you?
I think this is going to be one of the biggest stories of the winter, absolutely, because the diesel stockpiles are at the lowest levels going back to the early 1980s. You're seeing prices rise much more quickly than crude, and this is one of the main inputs for heating. So you have shipping, right? You've got trucks, and you have heating, and that's going to be a major issue.
Getting colder in New York. Did you feel that chill?
For a week, okay? I'm not going to say.
Are you going to do that New York thing? Which is like, this is nothing.
You're going to do the thing where it's like, oh, it's a little chilly. Is it going to be a bad winter? Oh, my goodness.
It's freezing. You know, when it gets cold, it gets cold. Tom does this New York thing as well. He's like, not when I was a kid and all that stuff. I mean, just,
I walked backwards.
Exactly. If it's cold, it's cold. Just say it's cold.
It's getting colder. People are turning on the heat. How about that? So it's starting to matter a little bit more.
Did you turn the heat on?
I did. Did you?
That's not good for climate change. That's bad for you. Coming up in the next hour, Colin Martin, fixed income strategist at Schwab Centre.
I walked backwards.
I just put on a sweater.
With no shoes.
That's what you should do.
Uphill.
Just put on your Montclair jacket and get on with it, Bramo. Suck it up. Equity futures are 0.6 of 1%.
This is fun.
That's probably what TK's doing right now, isn't it?
Wearing a Montclair
just
jacket.
Just sitting there in Montclair and a cigar.
Breathing with, like, you know,
complaining about the cost of energy. Yeah. Drinking some $10,000 glass of scotch. Anyway, yields up, then back down again by 5 basis points on a 10-year, 380 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, a majority of G20 nations are set to condemn Russia's war in Ukraine. That's according to a joint statement drafted for the summit that was seen by Bloomberg. Now, the statement refers to the war in Ukraine, but not Russia's war in Ukraine, a compromise designed to get as many G20 leaders to sign on as possible. British Prime Minister Rishi Sunak gave his strongest hint yet that he will protect pensioners from high inflation. Sunak told reporters on the way to Indonesia he has a track record of caring about pensioners dating to his time back as Chancellor of the Exchequer. He's facing pressure to stick to the so-called triple lock on pensions, meaning payments rise every year. Oil stockpiles in developed nations have sunk to the lowest level since 2004 as sanctions on Russian exports take effect. That's according to the International Energy Agency's monthly report. Supplies of diesel fuel are, quote, exceptionally tight, and prices may need to climb even further to rein in demand. International oil prices remain above $90 a barrel. Senate Majority Leader Chuck Schumer has teed up a vote to start debate on a bill to protect same-sex marriage. The bill's sponsor agreed on changes designed to attract enough Republican votes to win passage. The legislation drew out of concern that the Supreme Court could overturn an earlier ruling that established the right of same-sex couples to marry. And there's a sign that Warren Buffett thinks the world's leading chip maker has bottomed out after a sell-off of more than $250 billion. Buffett's Berkshire Hathaway has taken a stake of about $5 billion in Taiwan Semiconductor. Shares of TSMC had fallen 28% this year in Taiwan through Monday's close. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
President Biden made clear that the United States will continue to vigorously compete with China, including by making investments at home. And you've seen the Inflation Reduction Act, the CHIPS and Science Act, and by aligning with allies and partners where we have shared interests and challenges.
That was Catherine Tai, the US trade representative at the Bloomberg New Economy Forum in Singapore in the last 24 hours. From New York City this morning. Good morning. More on that conversation in just a moment. Here's a flavour of the price action this Tuesday morning. Equity futures on the S&P 500 pushing higher, up by 6 or 0.7%. Yields lower by 4 basis points, 381. And a dollar weakness returns. Euro dollar positive 0.8%, back to 104 on euro dollar, which 12 months ago was super bearish, I guess, for Europe, and maybe 3 months ago super bullish on a euro. So it gives you an idea of where we've been this year. Euro dollar 104.12. I want to return to those comments from Catherine Tai, because the more interesting quote for me was actually this one. The body language was very powerful from the photos of the two leaders greeting each other and standing together. She went on to say that's a powerful signal to the rest of the world in terms of two leaders who are capable of managing a tremendously complex relationship. It's interesting to me that this administration sees power coming from the ability to manage this relationship, when others might see power coming from your ability to confront China, almost taking a combative stance with them. Just the optics and the way they view the optics from this administration is slightly different, in fact, very different to the former leadership in the White House.
It's completely polar opposite. Rather than trying to just come out and look strong and look like you're going to fight, it's coming out and looking collegiate, and looking like we can accept that there's some really strong differences, but that everybody agrees they don't want a war. They don't want it to become something that harms everybody. And so there is some discussion that is more amenable, more kind in some ways.
For anyone interested in the inner workings of the G20 in Bali, and Anne-Marie's going to break this down for us, I'm sure, the president to skip the dinner at the G20 today, that sounds like the kind of thing I'd do. I'd skip the dinner too.
100%. Why do you think?
People wouldn't notice if I'd left, but obviously people are going to notice this. But I would remove, I've got a really good friend and they've got a great skill. They say to me that what they do is they turn up for the drinks.
Yes.
And then they go into the hall, and do you know what they do? They remove their name tag from the table. And then they go home.
What is this, tips to
Isn't
basically
that
ghost
gold?
to ghost the G20?
I think that is gold.
He's
so what you do,
trying to
you turn
really-
up for the drinks.
Really?
And if you don't want to go to the dinner, you have to go in early and remove your name tag, and then no one knows you're missing.
You know that your name's just being crossed off all these
I
really
think that's
important
that's
dinners.
gold.
G20, how to
Do you
ghost the
think
G20?
I get invited to any of this stuff?
100%.
Give me
You're
a
just
break.
like, you know, I'm
Ed
gonna
Karen does. He
walk
joins us
out.
right now, the Bloomberg Chief Asia Economics Correspondent. Isn't that great? I think that's such a great idea.
It's amazing.
And to walk us through how this has played out in China, in Hong Kong, following that meeting yesterday.
A big turn in sentiment, John. By all accounts, the reaction through the day was that meeting went much better than expected. Of course, expectations were pretty low, but listening to the conversations at the New Economy Forum and elsewhere, everybody was saying there's a guardrails are put in place now. It seems like there's a floor under all of this. You heard Henry Kissinger's remarks talking about building bridges. People like Kevin Rudd, a former Australian PM, saying it has ratcheted down tensions, etc. So that reaction has permeated through much of the day here, and that is flowing through to markets. At the same time, that we've had something of a pivot. I know we can argue this, but we've had something of a pivot or a swerve on COVID zero and on real estate by the Chinese leadership. Now, these three things coming together in the past few days do seem to be turning sentiment towards China. But again, I would say we're talking here about headlines, because if you want to look under the bonnet, all of these structural things, I mean, Catherine Tai made it clear today that they're not yet ready to roll back on tariffs against China, for example. All the structural issues against China's housing, real estate market, those haven't gone away either. So better sentiment, but all of these problems we keep talking about haven't gone away.
And you remember that old phrase, trust but verify? Where is there mistrust still in this administration, in the United States, when it comes to China?
All right, well, again, if you look at the three things going on at the moment, clearly there is a lot of uncertainty over China's ambitions towards some of the hot-button topics in the region. Obviously, the most obvious one being Taiwan. How will that play out? No one's quite sure yet. The fact that the language is where it's at around concerns over conflict shows you where the trust factor is there. So that remains very much uncertain. How will China deliver on this promise of onward engagement with the US? But it's also a question mark over COVID zero. I mean, again, the headlines have gone around. Reducing the international quarantine, changing up the testing procedures on the ground. These are changes, no doubt about it. But, you know, they still have a very aggressive system in place in China with deep infrastructure built in place to contain COVID. It's going to take, even if they are on a trajectory to reopen, it's going to take many, many months for that to happen. And on the real estate side of the story, well, hang on a sec. All of the mantra in recent years has been punishing property developers who speculated and borrowed excessively. Does anyone really think that mantra is going to change overnight? It's about stabilizing things. It's about putting a floor under things. But as I said to you earlier, none of these broader problems have been resolved, or neither have they gone away yet.
But there's a shift in emphasis, and I want to understand how significant the shift is about more of a decision toward the economy rather than just simply not just national security, but also with respect to COVID. Is there any credence to this idea that China truly has shifted back towards supporting its economy, especially as they get yet another slew of disappointing economic data overnight?
I mean, I think you are right, Lisa. We don't, the officials come out every other day and make the point that they will do whatever it takes to support the economy. And like you mentioned, we had bad data today. We had retail sales contracting in China in the month of October. And remember, it wasn't so long ago we used to rave about the potential of China's emerging consumer class. So the consumer is in a total funk. The industrial sector is under pressure because shipments are coming off. And of course, the investment side of things, well, it's mostly government spending. It isn't being led by the private sector. So there is no doubt the officials are showing a degree of urgency now in trying to turn things around and put a floor under things. But this is where we keep starting to go around in circles. It's open to interpretation. How broad reaching and how serious are they about these measures? We don't know yet, but we do know it's going to take a long time to fully unwind this COVID-0 apparatus. And by the way, how to do that without a public health disaster is a huge concern for them and the world. And of course, you've got the housing issues. How do they resolve the debt problem there? And how will the geopolitics play out? I mean, it's a better mood music, but there's a long way to go in all of this yet.
And are you the kind of guy that skips a dinner? I just need to know.
I like your tip about lifting the name badge, John. I'll have to remember that in the future, I think.
There you go. And the currency.
Punted.
People love this. People love it. No one likes the dinner. Fact. No one does.
Well, because of the food, because of the service, because you have to make small talk with people that
company,
you don't really want.
people you don't like, you don't want to sit next to. So then they mix people up. Hate that. Hate that.
So you think that Biden, if he's like maybe Emmanuel Macron,
no idea. Just
perhaps
the mixing
not really
people up.
To
hate
sit
it.
next to it. All right. Well, maybe President Biden will take your advice. And try to slip
he's
out
skipping
under
it
this.
anyway. I don't think he needs to take my advice. In the next hour, we'll catch up with Seema Shah of Principal Asset Management. Looking forward to that. Enda mentioned the data, and we can discuss the data in just a moment. Policy will also always take priority, primacy in markets over realised data, backward-looking economic data, because you want to dream about the data in our future off the back of the policy changes now. And that's what's happening in China at the moment.
When things get so bad, though, that you start to get some real public pushback, that there is a shift in tone with respect to supporting the real estate sector, with respect to opening up in an international sense after really years of not doing that, it gives you a sense that they're a little bit concerned about some of the economic data going forward.
So many messages on this.
People like to avoid dinners.
Yeah, they're talking about weddings.
Yeah.
Just how to skip the dinner.
If you want to ghost someone, reach out. John Farrow. He'll tell you.
Hey, don't push that too far. Equity futures up 0.7 on the S&P from New York. This is Bloomberg.
NEC was started under President Clinton, and Bob Rubin was the first person to hold that job. Can you explain to people what it actually does and what the NEC does day to day? When, for example, who's in the NEC, who's on the NEC, what is your job actually to do?
So the National Economic Council, the job, the mandate, the mission of the organization is to coordinate economic policy across the executive branch and across the cabinet to make sure that the president is getting the benefit of when making decisions of his entire economic cabinet, and also that the economic cabinet is getting clear direction from the president as well. So that two ways. So it's a coordination function. On the NEC itself are all of the relevant cabinet members, the sort of core economic team, OMB, Council of Economic Advisors, Treasury, but also Secretary of Labor, Secretary of Commerce. My team, the NEC team, is a small team within the White House that is, our job is to do that coordination across the range of economic policy issues.
Now, you were the deputy in the Obama administration at the NEC. Now you're the director. Which NEC worked better, the Obama administration one or the Biden one?
Well, on the issues that I worked on in the Obama administration, it worked very, very well. And the current NEC works very well as well.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
There's a sense that there's something out there that hasn't worked itself out yet.
The Fed still feels like they still have to go higher on rates to cool inflation.
In reality, we're going to see certain factors and elements of inflation remain stickier for longer.
Inflation's going to be, it's less about the peak, it's how quickly it's going to decline.
I don't think the peak inflation, peak Fed narrative ever really went away.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK's back tomorrow. Equity futures right now on the S&P 500, bouncing back by 0.75%, bouncing back and going into numbers from Walmart out any moment now.
Yeah, after we got Home Depot, that were better than expected, at least in terms of the prior experience, but perhaps the forward look a little bit more pessimistic. I am curious about how much we see consolidation in some of the biggest real retail names, just simply because they can negotiate better and they can get better contracts perhaps with employees.
Are we going to start to see the middle and high-end consumers shift down towards Walmart?
We already have.
We have in the last couple of quarters. Will we see more of that? I'm actually more interested in the retail numbers this morning than I have maybe with other sets of earnings over the last couple of weeks. I think this could be really interesting.
It's a great point. How many people are going from Whole Foods or Whole Paycheck, as Tom Keene likes to call it, going to Walmart instead because they see the visceral response to how much inflation has gone up, how much inflation has pushed up their grocery bill, and are shifting as a result. If Walmart does well, is that a good sign or a bad sign for the rest of the retail complex?
I don't think it's a good sign, the amount of cuts we're seeing going into the holidays at all. And for two reasons. One, losing your job going into the holidays is brutal. Seeing those headlines is just absolutely brutal. And I always struggle when we read these headlines with like 10,000 here, 20,000 there. Real people making up those numbers. That is bad, bad news going into the holiday. And then the overall signal you get from that, the fact that you've got to right-size the business going into a very, very busy period for consumer spending in America and worldwide, that's a problem.
Especially because a lot of people thought that the low hiring numbers that some of these retailers are putting out in terms of seasonal employees were just simply a result of them having so many employees already that they want to keep on a regular basis. And then Amazon coming out, reported by the New York Times, saying that they're going to cut 10,000 workers, highlights what you're just talking about, that perhaps even in the key selling season, it's not going to be that good. And we saw that from Apple, too, actually. We saw Apple coming out and giving a discount to small businesses on certain products which is very unusual.
When do you see that from Apple?
Exactly, because even their Mac sales, their iMac sales, which did really well, they're starting to get a little bit concerned. Again, this speaks to exactly the story you're speaking.
When we get the numbers from Walmart, Lisa's going to break them down for you. Just ahead of that, here's a sense of the price action this Tuesday. Equity futures are higher, yields are lower. And I have to say, the Fed pushback didn't last long in this bond market. Yields are lower again by 5 basis points on a 10-year at 380. On a 2-year, yields are lower there as well. After having a look at 440 in yesterday's session, we're back to 435. Yields down there, Bramo, by 4 basis points. And you can see the move in the FX market. Dollar weakness back on a screen, euro dollar 104.
It's a reverse of everything that we had been seeing. Even the real yields on 10-year treasuries, we're also seeing come down in around the lowest levels that we've seen going back to October. We will break down those Walmart numbers when we get them. We're still waiting those. We got Home Depot. They did beat on third quarter sales, comparative sales, 4.3% of a gain there versus an estimate of 3%. But their forward look wasn't perhaps as positive. 8:30 a.m. PPI for October, Empire Manufacturing for November. How much do we get a sense that it was a one-off or not that we saw the CPI come in softer than expected? A good downside surprise last week. Do we get a confirmation of that, particularly even with the idea that services inflation continues to be very robust and is expected to? Today, we are going to get a host of Fed speak, including Philadelphia Fed President Patrick Harker and Fed Governor Lisa Cook, both independently speaking at 9 a.m. Also, Fed Vice Chair for Supervision Michael Barr will be testifying in front of the Senate Banking Committee at 10 a.m. A lot of people are looking for some sort of discussion on crypto assets. I want to know what he sees in terms of the bank's ability to withstand losses from some of their investments and still extend credit to both consumers and businesses, because that might be the biggest risk with respect to what some of the banks are dealing with some of the hung bridge loans and other assets in their books.
More Fed speak still to come. Everyone's really looking forward to that. Thanks, Bramo. Seema Shah, Chief Global Strategist of Principal Asset Management, joins us right now. Seema, I was just going through your notes quickly. Europe likely already in recession. The US will enter recession in Q2 2023. How much work have we got to do to discount that when it comes to earnings?
I think you just hit the nail on the head, and that is the most important thing. When we're looking across the market, I think we're starting to see a bit of a consensus forming. You know, there's a general view that, look, yes, the Fed is going to downshift to 50, but there's a little bit further to go. The difference now is where the market is thinking is, what is the implication of those Fed hikes today and maybe a little bit more next year? Is there going to be a recession? How bad of a recession? And how bad is the earnings recession going to be? And that's where you're getting a bit of a disparity in views of, you know, this is time to be risk on, or this is time to be, you know, maybe a little bit further to go from a technical side, but how much further can we fall from this point? And I think from our perspective, we are expecting the recession to come through in Q2. We do think that there will be a fairly significant drop in earnings. I think the timing is very difficult to call at this stage. But what the implication is that we may get a little bit of a run through for markets through to year end, but then you do get these renewed falls, which I think could still retest those September lows.
Timing's tough. Let's talk about size. This is what BlackRock thinks. For consensus earnings next year, they're seeing growth of just over 4% in 23. They say we expect 0. We've come down a lot from the start of the year to just 4% earnings growth expectation for 23. They expect 0 earnings growth next year. Seema, do you share that kind of level of skepticism about what earnings can do next year?
Yeah, I think we're on a similar level there. You know, as soon as you're expecting a hard landing, then I think the earnings recession always has to follow through in this situation. The difficulty at the moment is just that actually the data has been really resilient. You kind of came into Q3 earnings season, a lot of, you know, concerns that maybe we start to see some really bad numbers. It wasn't that bad. I mean, you know, energy certainly did hold up the space, but overall, you didn't get a picture of companies which are really, really struggling. So we're still expecting that to come through. But I think that's where some of the disparity is coming through. So some people saying that, look, earnings, a lot of it is priced in. And from our perspective, we don't think it's fully priced in yet. And that's where you get that additional leg down.
There's a consensus right now that we were talking about earlier about stagflation, and another consensus on the heels of that, which is go long treasuries. And we're seeing that increasingly baked into what a lot of people are saying. Do you think that that is the one reliable trade to go into long duration, developed market government bonds, particularly the U.S., and hold into a really messy 2023?
Absolutely. You know, we had portfolio discussions yesterday. You know, we have to revisit after the kind of moves that we saw last week if there's any changes that we want to make. The one thing that we can all, I think, clearly agree on, that it's time for duration. You know, we are expecting recession that should put further downward pressure on treasury yields, and anything long duration. So this is a time to maybe continue thinking about quality. But as you said, long duration treasury bonds, investment grade, high quality is the place to be sticking in for the time being as we move towards 2023.
When you talk about duration in bonds, I think about duration in terms of the downturn. And you're saying, Seema, that we're almost certainly heading into some sort of downturn. And there is a huge dispersion between people like PIMCO that see this being a prolonged sort of slow grind that perhaps is shallow but lasts a long time, and something that feels more severe, a shakeout that then reasserts a trend that we've seen in the past. It sounds like perhaps you see the latter if you do see longer term yields coming in substantially. Is that right?
Well, so no, we're expecting a recession which starts in Q2 and it goes on for 3 quarters. I mean, that's a pretty standard, it sounds quite short, but it's actually the average length of a US recession. So we're not expecting there to be too much pain, nothing of certainly of the GFC type levels. But that should in itself be enough to push down treasury yields a bit. Now, do we go back to the kind of levels that we've been used to over the last couple of years? No. But that's because from a longer term perspective, we are expecting this to be more of an inflationary era, which will keep that upward pressure slightly on treasury yields, so not going significantly below that 2.5% level.
Seema, look at these numbers from Walmart. Adjusted EPS for the third quarter, 150. The estimate, 132. They've approved a new $20 billion share buyback authorization. They've raised their year outlook on strong results for Q3. Is it good when Walmart does this well, or is that bad, Seema?
Yeah, that is the debate. As you see people, I know when I look at my spending, you see the prices out there, and of course you're going to be shifting towards lower cost purchases. So that would certainly feed through to a positive picture for Walmart, but certainly it does suggest that actually consumers are starting to struggle. And when you throw in the increase in mortgage rates in there, we are expecting places like Walmart, if there's anyone's going to be that perform as well, it's going to be the Walmart, the Targets of the space, rather than it being taken as a very positive story.
Walmart right now up 5% in the pre-market, 145.90. That stock has really outperformed through the year so far. I think coming in today was only down about 4% on Walmart. So here are the headlines for you. The numbers come in at 150, adjusted EPS for the third quarter. The estimate was 132. You've got a $20 billion share buyback authorization in there as well. Because of these strong results for Q3, they've raised the year outlook on those strong results, significantly improved the inventory position in 3Q as well. Now, the inventory position, Lisa, is a big, big story when it comes to goods disinflation in America. And of course, this goes well beyond Walmart. So that's a decent read for the name. Is that a decent read for the economy when you read those kind of headlines?
Seema Shah says no, and I think you asked the right question. Is this basically people downshifting? Take a look at the grocery sector. They say they're making significant inroads in getting market share in the grocery sector. How much does this speak to exactly what you're talking about? People who are perhaps in the middle or upper income brackets going to Walmart to shop rather than Whole Foods.
Neil Dutta of Renaissance Macro right now, just writing in. Neil, thanks for watching, as always. Walmart booming is fine. Come on. What gets cut back in this recession? He goes on to say, and I think this is the interesting point, the economy is speeding up. US consumption is growing 4% in real terms. If everyone prepares for a recession, is it less likely or more likely? He says it means it's less likely. There is no element of surprise. What do you make of that?
Well, that's perhaps what other people are saying by saying it's baked in. I just want to make this, though, that they see a full year adjusted EPS down only 6 to 7% versus the expectation of 9 to 11%. This is doing less bad, right? So to his point of, if it's baked in, does it make it less likely to really have the same kind of oomph when it comes to fruition?
Let's pick up on those comments from Neil in just a moment. Equity futures right now up 0.8% on the S&P 500. With Lisa Abramovich, I'm Jonathan Ferro. TK's going to be back in the seat tomorrow, I'm happy to say. He's really shortening up these trading weeks, TK is, into year-end.
He's trying to.
He complained all summer about not taking time off, and now he's taking the rest of the year off.
Good for him. Enjoy it.
Good for him.
Yes.
Okay. Bond yields down 4 basis points from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Former President Trump is set to announce he's running for the White House again. The announcement will come tonight at his Mar-a-Lago club in Florida. But Citadel's billionaire founder Ken Griffin thinks Republicans should look elsewhere.
He lost in 2020. We lost Georgia because of his behavior in the Senate race in 2020. That's a second loss. And then this year, the Republicans lost the Senate because the Trump-backed candidates in the Senate races were rejected by American voters. That's a 3-time loser. And I'd like to think that the Republican Party is ready to move on from somebody who's been, for this party, a three-time loser.
Griffin supports Florida Governor Ron DeSantis. He spoke at the Bloomberg New Economy Forum in Singapore. In Arizona, Democrat Katie Hobbs has turned back a prominent election denier to be elected governor. Hobbs defeated Republican Carrie Lake, who embraced Donald Trump's baseless claims of fraud in the 2020 election. The Associated Press called the race with about 98% of the ballots counted. Hobbs has a more than 20,000 vote lead. The U.S. and Indonesia have announced a climate finance deal providing $20 billion to help Indonesia pivot away from coal power. The Biden administration calls it the largest single climate finance transaction ever. It will be outlined at the Group of 20 summit in Bali. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There's this downside of where we are, but there's also this incredible upside. People are chasing fusion. They're chasing green, blue hydrogen. They're chasing battery storage. Something's going to break through.
Bloomberg, your global business authority. Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority. multi-trillion dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Global inflation and recession, an energy crisis intensified by war, and the aftermath of a pandemic. Today, world leaders are meeting in Bali for the G20 summit, and Bloomberg is there bringing you the news and analysis.
A confluence of economic, climate, and security crises make it a uniquely challenging time.
All of these are pointing towards a big slowdown in trade.
It all starts today, only on Bloomberg, your global news authority.
I absolutely believe there's need not be a new Cold War. I do not think there's any imminent attempt on the part of China to invade Taiwan, and I made it clear that our policy on Taiwan has not changed at all.
No news is good news. Over in Bali at the G20, the President of the United States after his meeting with President Xi of China. Live from New York, equity futures pushing higher. Walmart absolutely flying after delivering an earnings beat and more just moments ago. Walmart is up by more than 7% in the pre-market. Yields are lower by 4 basis points on a 10-year 380.87. The dollar's weaker. This is kind of a bull's dream, isn't it, right now? Euro dollar 104.03. Euro dollar positive by 0.75%. The President of the United States is said to skip the dinner over at the G20. Had a conversation here about whether you should be skipping dinners too. Mr. Doubt Hotel on Twitter right now. I'm with you 100% on skipping the dinner, my man. Small talk with people you'll never see again. Lukewarm lamb noisettes and boring speeches. No thanks.
You know,
you on board with this, skipping the dinner?
I would go.
I'm so on board with skipping
like
a dinner.
I think it would be interesting. I think that it would be, some fascinating conversations.
I like people I'm friends with.
Yeah.
That mixing stuff. We've already made decisions, haven't we?
All right, I would go.
Okay. Anne-Marie joins us now.
I'm going to take the unpopular view.
You always take the other view anyway. Just a default setting. AMA's from Bali. Anne-Marie, walk us through why the President is skipping a dinner at the G20 and whether it's relevant at all to what's going on over there.
Well, I wish I was taking the president's space because I would love to go to the G20 dinner surrounded by all the leaders. Listen, the president met with all these leaders throughout the entire day. He obviously had a huge night last night, sitting down with Xi Jinping the first time as president of the United States. He sat across from Xi Jinping. He's going to be working with his team this evening, we're told, to deal with some non-urgent domestic issues. But also you have to think, I mean, this is a very long journey from the United States. The president is just off the midterm elections. He was in Cambodia over the weekend. Now he's in Bali. Maybe he's just a little bit tired. He does turn 80 on Sunday, so it's a little bit tiresome for the president. We should note, though, it is not COVID-related because there was this scare because the Cambodian prime minister came out today on Facebook. The president spent a pretty lengthy amount of time with him over the weekend. He came out saying he tested positive. The president this morning, though, tested negative for COVID.
Anne-Marie, just how is the meeting, or how has the meeting between the two leaders, President Xi and President Biden, played out in Bali?
I think everyone is really receptive to the fact that there is going to be continued negotiations and a continued conversation and a dialogue they are going to see from Washington and Beijing. American allies like Japan, South Korea, Australia, those in Europe, they want to see communications between these two countries. And you know that over the summer, these communications really fell to zero. Absolute deterioration in the relationship after Speaker Pelosi's visit to Taiwan. On the military front on comms, on the dialogue when it comes to climate change, but also the fact that we saw China have these very provocative military drills in the Taiwan Strait. So the rhetoric was very hot. That has all now cooled down, and that has been welcomed. We should also note that China is really starting to put their thumb on the scale when it comes to putting pressure on Vladimir Putin. It is very obvious to me and others at this G20 that Russia is increasingly isolated, and China has a lot to do with that. The fact that China was able to sign on to the U.S. readout, I'm sure they had a say in that they do not want to see a nuclear force. We heard this from Xi Jinping as well when Olaf Scholz went to China. They don't want to see nuclear use in Europe. We also are likely going to see a G20 communique with all of them signing up. It won't say Russia's war, but it will say war in Ukraine. Russia likely didn't want to be the one lone wolf if they weren't able to get China on to dissent to that communique.
So what does all of this have to do with semiconductors? And I ask this because we've seen a huge rally that just continues, and we thought that that was one of the biggest issues coming into this. Do we get any insight on what the policy is there?
At the moment, the policy is status quo, right? What we have from the United States is that they maintain that they are going to continue to have these curbs on semiconductors that have this U.S. technology to China. China obviously wants this to advance their technology space, also crucial to advance their military capabilities. But right now, the fact of the matter is the U.S. is not backtracking on this policy that came out from the Commerce Department, which obviously is something that has drawn a lot of concern and has been an annoyance for Beijing. The other big thread about semiconductors that we should discuss is the fact that whether it's semiconductors or also President Biden's the administration's recent Inflation Reduction Act, there is a growing chorus from allies, whether it's South Korea, whether it's the Netherlands, whether it's Emmanuel Macron, who's made his point very clear in recent statements calling it unfriendly. There are issues that allies take aim at the United States with behind the scenes. When it's semiconductors, if there's any little bit of U.S. technology, does that mean they cannot ship to China? Will that cut them off as well? So you see a more bifurcated world. And the same with the Inflation Reduction Act. What you hear behind the scenes is that they feel that this is not fair to their companies if the U.S. is going to give subsidies to American companies. So there's a growing chorus of that. But overall, there's been a lot of unity amongst the West at this G20 summit.
Talking about the West, we're going to hear from a bilateral with both the Italian Prime Minister later today. Tomorrow and Wednesday, we are going to expect to hear something from UK Prime Minister Rishi Sunak. We do have a new UK Prime Minister, of course. Which one are you watching most closely in terms of the next meetings that Biden has?
So Biden already had his meeting with Giorgia Meloni, and it was the first time he sat down with her. Of course, one of the big topics those two discussed was going to be energy security. Italy is so reliant on Russian natural gas, and obviously we saw former Prime Minister Mario Draghi really take this very solid tone when it came to putting penalties on Putin. And I imagine the Biden administration wants to make sure that same tone continues to Giorgia Meloni from who has developed this far-right government. The next meeting, I think, is a little bit more interesting with UK Prime Minister Rishi Sunak for a number of reasons. One, particularly the fact that this is President Biden's third UK Prime Minister in his entire administration. That's almost 2 years. He's dealing with his third UK Prime Minister for a relationship that the US and the UK like to call special. So this one, I think they want to make sure it goes well.
AMH, wonderful work as always. Anne-Marie, thank you. And on Twitter, why are people so mean on Twitter? Tal Ferro, maybe if he stopped skipping dinners, he could get his clothes in the adult section and bulk up a bit. Brutal. What is it about?
Oh, my goodness.
The insecure American man and the slim fit suit. What are they scared of?
They just are jealous.
What's wrong?
They're just jealous, you know, slim fit.
Brutal out on Twitter. Elon Musk, clean it up.
Oh, yeah, that's really going to be the person to do it. Did you see all the advertisers that are pulling back? I mean,
I saw a couple. Sure. I mean, let's give it time. It's early days. Let's see what happens.
Well, he's cutting contractors, too. I know, it's early days. Let's see what happens.
Super early days.
It's early days.
Super early days.
Super early days.
Coming up, Colin Martin. Looking forward to that conversation from Schwab Center. I don't think he wants to talk about this. No. Might talk about slim fit suits.
I think he will.
From New York, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
2 hours away from the opening bell, this equity market rally, bear market rally, call it what you like, took a pause yesterday after the biggest two-day pop on the Nasdaq since 2008. Lower yesterday, bounced back today by 1.5% on the Nasdaq 100. On the S&P 500, futures positive 1%. Heard a lot of people tell me this market just wants to go higher right now. In the bond market, I think this story speaks to that. The fact that you've heard from Governor Waller, he said calm down. Governor Brainerd, Vice Chair Brainerd now, we have additional work to do. And the two-year yield is lower again still in the face of that pushback from the Fed. 4.3529 on a 2-year. On a 10-year, 3.8050 on a 10-year. We're down by 4 or 5 basis points there. Yields lower, dollar weaker. Euro dollar looks a little something like this. 1.0409. Positive 0.8%. Some real dollar weakness out there, Brahma, this morning.
I'm still stuck on the market wants to go higher. Does the market also like ice cream? Maybe when people start to give some sort of emotional reality to the market, I have to wonder what they're looking at.
Sometimes you can understand something from the way the market responds to incoming information.
The market likes ice cream. Perhaps the market also likes Walmart.
The fact that the equity market is higher and bond yields are lower this morning, even with the Fed pushback, I think speaks to something. To your point, what do you want right now? I want lower yields, I want a weaker dollar, and I want decent earnings. And I've had all three.
Yeah, and there have been whispers around some of the stories that have been the biggest issues for people, whether it's China or whether it's Europe. So people are kind of leaning into that. Some of the earnings that we got today perhaps paint a different, more motley picture in terms of the gainers and the losers. Home Depot reported around 6 a.m. Eastern, those shares lower by about 1%. Interesting when you dig beneath the numbers, because the headline numbers came out better than expected. But looking underneath, their inventories were building. How much of this is an inventory story? How much are they going to have to discount things going forward? Also, traffic is falling. How much of the better than expected earnings are a result simply of inflation? And you're going to see this kind of reaction. Why are you smiling?
Because you can't help yourself.
Okay, like, yeah, you're right.
You had to go through those earnings and find something negative about them.
Well, they're down. Someone else found them for them.
By what? 1%.
All right.
Carry on.
So people could come back at me with hate mail for Home Depot and painting it a negative picture, but it seems like the market feels
similar.
Tell me
what's bad about Walmart this morning.
There is absolutely nothing bad about Walmart. It's up 6.4%, but perhaps bad about the broader economy if you want to go there, because perhaps people are going to Walmart rather than other grocery stores because they're able to discount things. I thought it was really interesting that they actually are gaining market share in grocery types of products. Also interesting that they've cleared out their inventory issues. So this is also an execution story as much as it is also just simply a demographic story.
Well, Whole Foods is nuts. We've talked about that a million times. Tom's called it whole paycheck for a long, long time. There'll be a lot of people downgrading from those high-end franchises, if you want to call them that.
Yeah, you're starting to see that. And I also was looking at some of the chip sector. I think it's interesting that chip companies are doing so well. You're seeing this massive rally. And on what? I'm just trying to think. I mean, what are they getting right now from this meeting from Bali?
I don't know about that. I think what's interesting about the chip makers is just how quickly the story's changed. with that industry. It's amazing. It's gone from undersupplied, too much demand, to oversupply and not enough demand very, very quickly. To see cuts at places like Intel, not what you would have expected maybe 12 months ago.
Which makes it even more confusing that the semiconductor index, Philadelphia Semiconductor Index, is up 26% in the past month. And this goes to your point about the whipsaw action that you're seeing in markets where the market wants to go. How much is this simply because people don't really have a handle on basic things like economic cycles, business cycles, inflation? I mean, these are all mysteries, and they've been moving so quickly.
You hate that line, don't you? The market wants to go higher.
I don't hate it. I just have, lots of images of, does the market wear a hat when it's cold?
Colin Martin joins us now, fixed income strategist at Schwab Center for Financial Research.
You could ignore that.
Colin, do bond yields want to go lower?
I think they do. When you look at the movement lately, with the CPI report and then even with the comment from various Fed officials, we're seeing them trickle down. And I think part of that has to do with hope. We got one really good CPI report, good in the fact that it was lower than expectations, and good in the fact that maybe it allows the Fed to slow down. And then when you look at comments from the Fed officials, I think you can look at specifically Brainer's comments and find something for both the hawks and the doves. But I think what people really focused on was her using the term downshift and focusing on the expectations that December will be 50 basis points versus 75 basis points. And again, going back to last week's CPI release, I think there's hope that we do see that trend continue. I think the Fed wants to slow down its pace. I don't think the Fed wants to get as high as it needs to. And I think the Fed's also hoping that they see inflation come down. But for now, it looks like there's a little bit of both in the comments. We're not done yet. But behind the scenes, I think that a lot of Fed officials are hoping that last week's CPI release will translate to the upcoming PCE report, and then inflation prints down the road.
Governor Waller was pretty blunt about it in Australia Sunday evening. He said, calm down. There was real pushback, Colin. If that was a number of weeks ago, maybe even a number of months ago, maybe we'd see bond yields higher, much, much higher, and they'd stay there. What do you think's happening now? What's changing? You've touched on it briefly. Just build on it. What do you think's changing now? Why are we ignoring some of this Fed speak in a way that we wouldn't have maybe more recently?
No, I do think, again, I'll just go back to the inflation print, because the Fed can talk a tough game, which I think they need to do. The Fed, they know they were behind the curve, and they need to act tough and talk tough. They need to make sure inflation comes down. And I think they're kind of just hedging their bets right now, and they're saying we need to keep at it until we see inflation consistently move down, not necessarily to 2%. I think that's going to take a while, but to something that they're more comfortable with. Obviously, one CPI print is not going to be the be-all, end-all, but I think we're seeing signs of it elsewhere. Something that we've been focusing on a lot is the housing market. We're already starting to see that slow down, and we're expecting a lot of other areas of the market to slow down as the cumulative tightening we've experienced works its way through the economy. So again, I think a lot of it is hope, expectations that what we all think will happen will actually happen. But as time progresses, and if we get a continued chorus of Fed speakers pushing back more and more, then I think the narrative changes a little bit.
There's been a shift in terms of how much people respond to the idea of how many rate hikes and how quickly the Fed is going to raise rates versus how long the Fed is going to hold rates, perhaps at 4 3/4% or 5%. Has this market, have credit markets fully priced in a 5% or 4.75% Fed funds rate next year for the bulk of the year? Has that been priced in?
We don't think it has. When you look at the credit markets, whether it's IG or high yield, they're really hanging in there. They're performing well. Credit spreads, especially high yield spreads, aren't pricing in much risk. Spreads are close to their long-term average. They've actually come down sharply lately. And the way we interpret it, it seems like they're just shrugging off the negative impact of this tightening. Now, we do expect spreads to rise. Ideally, we don't want them to. That would be a bad thing. We don't want our clients to get hurt. We don't want corporations to fail. But we do think that's the likely outcome here as borrowing costs rise and continues to work their way through the economy, as consumer spending slows. We think those are all risks. And Lisa, to your final point, I think what the markets are underappreciating is the risk of having rates so high for so long. We've seen periods in the past where we've seen some volatility, yields have risen up, and maybe corporations didn't come to market with new bonds because they didn't want to lock in those high yields. If we see a Fed funds rate of, say, 4 3/4% or more for 6 months, 9 months, 12 months. That's a long window for corporations to just sit on the sidelines when they likely need to refinance debt or issue debt for any purpose. So we think the markets are underappreciating that risk. And we're still a bit cautious right now. We're focusing on quality when it comes to the bond market and what we're suggesting our clients do.
Just to go full circle, Colin, is there anything in the Fed rhetoric that has given you any pause with the assumption of their willingness to hold rates at, say, 5% or even below that for a year?
They've told us they don't want to cut, and we're taking them at their word. And when we look at the outlook, it seems like markets are kind of bouncing around depending on whether it's going to be a 4 3/4% peak rate or 5% peak rate. We think what's more important is how long they hold it there. And for better or for worse, officials have sort of pushed back at a quick pivot. I think we need to retire that word, but push back at the idea that they'll start cutting quickly. And that's our case as well. We think they'll get to whatever that peak is and likely hold for a while, through the end of 2023 or maybe into early 2024.
I think this is the third time we've traded the pivot, Colin. It's at least the third time. Colin Martin, thank you, sir. Charles Schwab. How many times have we done this? I think we did it in the summer a few times.
We called it
did it in the summer twice, didn't we? Now it's the step down.
The step down.
But we do get a step down. Most people assume we will. 50 basis points in the middle of December. We've still got one more CPI print before we get there. That can completely reform the conversation. You realise that, right?
Yeah, I do.
December 2nd you get payrolls, December 13th you get CPI, and then December 14th is the Federal Reserve meeting.
People still believe in the pivot, because if you don't believe in the pivot, then have we really understood the consequences of holding rates at 5% or even 4 3/4% for a full year or more, which is exactly what the Fed is saying, into, to your point, John, a slowing economy. So it means an even more restrictive monetary policy.
But the good news is, and what you'd hear from the equity bears, is that pushing out the weakness is not here yet. They think it comes the start of 2023. It's not here yet. They keep pushing it out. Resilience is the story of this economy at the moment. In the face of rates that have gone up 400 basis points in 8 months, it's pretty phenomenal that things haven't broken in a big way.
Which is perhaps akin to people covering their ears and going, la, 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 la. I mean,
I get what's happened in housing and the economy there, and I think that's really, really important. I see what's happening in tech and all the layoffs, but if you told me they were going to raise rates 400 basis points, I think I would have guessed that the data would be somewhere else relative to where it is right now.
Have we priced in stagflation to the equity valuations currently? Because we saw that survey, and I keep going back to that Michael Hartnett idea of 92% of all surveyed investors see the likelihood of stagflation being present.
Sure.
Has that been priced in? And if not, what do people have to see to price that in at a time when we are going to see slowing growth and inflation will likely remain higher?
Have I ever told you how much I love Michael Hartnett?
You have.
Over at Bank of America.
He has an open invitation, right?
Equity futures at 1% on the S&P 500. Walmart's absolutely flying this morning. Their stock is up by 6.6%. So equities up, the earnings from Walmart pretty decent, yields are lower, the dollar's weaker. If you woke up this morning and you had a dream last night of everything you wanted so that you could get stocks higher, you're kind of getting it this morning at least. Yields down, dollar weaker, earnings okay, stocks are up, the rally continues. Bramo's skeptical.
Of course I'm skeptical.
As always, sort of default position there.
100%.
Look, we've seen this movie a few times and it ends the same way, doesn't it?
Always.
Let's see if it ends any differently this time around. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Donald Trump is barreling ahead with his plans for his third run for the White House. He's expected to make the announcement at 9 p.m. New York time. At the same time, a growing number of Republicans have abandoned the former president over last week's dismal showing in midterm elections, and even some supporters urged him to hold off on the announcement until after next month's Senate runoff in Georgia. The European Union has formally begun a training mission for Ukraine. The goal is to educate up to 15,000 Ukrainian soldiers on the territory of EU members. The EU also approved more than $16 billion to finance the delivery of ammunition and other lethal military equipment to Ukraine. Skybridge Capital founder Anthony Scaramucci says due diligence that he did on FTX CEO Sam Bankman-Fried wasn't enough. Scaramucci says he's now trying to buy back FTX's 30% stake in Skybridge.
I'm hopeful that I'll be able to negotiate now with the trustee or the administrator of the bankruptcy a reasonable price for that equity, and we'll buy it back. And our business has been hurt by the association. There's no question about that. But I also think it gives me an opportunity to talk about this very transparently.
Scaramucci was interviewed at the Bloomberg New Economy Forum in Singapore. Well, shares of Walmart are rising today. The retail giant raised its outlook after strong quarterly sales. Walmart also announced a new 20 billion share repurchase plan. The company said it has significantly improved its inventory position and it continues to gain market share in its U.S. grocery business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When I started, I had no idea it was going to turn into this. This is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How do Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
I think it will probably be appropriate soon to move to a slower pace of increases. But I think what's really important to emphasize, we've done a lot, but we have additional work to do both on raising rates and sustaining restraint to bring inflation down.
Vice Chair Brainerd with Bloomberg's Peggy Collins. Fantastic conversation yesterday afternoon, as you might expect. From New York City this morning, good morning. A better morning again for equity market bulls. Futures are higher going into the opening bell, about 1 hour and 50 minutes away, 1 hour and 42 minutes away. Equity futures up 1%. The numbers out of Walmart better than expected as well, almost across the board, throwing a monster buyback as well. That helps things out. Something else helped things out as well. Yields lower by 5 basis points. 10-year, 380, 50. Euro dollar, dollar weaker. Bramo euro dollar, 104.08, positive 0.8%.
You sound so positive. It's basically a bull market.
Just reflecting the positivity on the screen, all right?
Okay, it's true. And it has been good. But how much do you really get the sense that people have conviction around this rally?
Zero.
I mean, you even have people like Mike Wilson coming out and saying, sure, okay, this can go further, and then we're going to see the pain. And that sort of seems to be what we're hearing from most people, actually, who come on the show.
Totally agree. Totally agree.
I just have to, provide that other...
We're on the same page. We nearly always are, all right? Got to head down to Washington, D.C. And just a warning going into this conversation, there's a lot of noise behind Andy Barr, the Republican from Kentucky and ranking member of the House Subcommittee on Oversight and Investigations. Congressman, you and I were joking in the commercial break. It's the chaos of Washington. If the chaos of Washington returns and that noise comes back, I'll let you go, sir, for sure. You made easy work of Kentucky's 6th Congressional District. Other Republicans struggled. Let's start there. Congressman, what went wrong with the party at these midterms?
Well, I'm an optimist. I'm a bit of I have a positive attitude, and so however you cut it, and no doubt Republicans are disappointed that the red wave did not materialize, but however you cut it, we made material gains in the House, and it looks like we're on track to taking the majority. In fact, some media outlets have already said we have, in fact, taken the majority. That was the principal objective, even not taking the Senate. What does that mean? It means that they don't give out small, medium, and large-sized gavels. They just give out gavels. And by retiring Nancy Pelosi as Speaker of the House, by having a new Speaker, by having Republicans in charge of the gavels and the committees, it means we set the agenda. We have the ability to exercise oversight. We can put the brakes on the overspending and the threat of higher taxes, and we can exercise oversight over the regulatory assault on the free enterprise system. That's what the market should take encouragement by in this election, is that we do have divided government, even though it's going to be a thin majority.
So who would you like to see be the leader of the House of Representatives? Is it Kevin McCarthy? Who would you like to see to be the leader of the Republican Party? Is it former President Trump?
No, it's Kevin McCarthy. Kevin McCarthy. No one has done more for the House Republican Conference than Kevin McCarthy in terms of raising money, helping recruit candidates, helping members represent their districts, moving their legislation, assisting them, understanding their districts. So Kevin McCarthy is going to have the votes not only to win his leadership election today, but also become Speaker. Now, look, there's competition, and the great thing about the Republican Party, both in these leadership elections in Congress and I anticipate in 2024, is there will be competition. There is no coronation in the Republican Party. That's the great thing about the Republican Party. We are not an authoritarian party. We are a libertarian party. We believe in free enterprise. We believe in competition and choice. We don't believe in top-down. We believe in bottom-up. And so competition, iron sharpens iron. That's what makes us better leaders.
How important is it to you, Congressman, for President Trump, former President Trump, not to run again in order for Republicans to kind of reclaim that mantle, given the turnout, what recently was the vote in the previous 2 elections?
Well, I think we have to do some soul searching in our party and recognize that certain candidates for Congress underperformed other candidates. And what do those candidates look like? What were the features of those candidates? Again, we're the party of competition and choice. So I'm not one to say this candidate shouldn't run or the former president shouldn't run. I think there will be a robust competition. I do not believe there will be a coronation for the nomination. But I want to say this, too, about 2024. We're getting ahead of ourselves a little bit. The crises that are facing us right now have not changed since Tuesday. Inflation continues to be a massive 40-year problem for our country. The crime problem is significant. That's why a lot of Republicans did well in places where you've got a crime problem. The border crisis is significant. The energy crisis, the attack on American energy independence, it continues to be a big problem. And the president's approval rating continues to be at 40%. So even while the American people didn't give a mandate to Republicans, they certainly didn't give a mandate to the Democrats when they gave Republicans control of the House. So it's dissatisfaction all the way around, and it means that Republicans and Democrats alike need to do a better job responding to the problems facing the American people. Republicans in the majority are going to be laser focused on this inflation crisis. And I want to say this to your audience in particular. No amount of Federal Reserve tightening is going to solve this inflation crisis. There is a supply side problem as much as there is a demand side or excess demand issue in the economy. And we need to produce and supply more American-made energy in this country to fix the supply side. We need to take off the table the threat of higher taxes and over-regulation, which impedes business investment, impedes the repairs that need to take place in the supply chain. If we don't do that, we are not going to get out of this inflation spiral, and you're going to continue to see aggressive tightening that will disrupt the financial markets.
Congressman, you said it. We've got an approval rating for the president in the 40s. We've got inflation at a 40-year high. And still, this is the position that the Republican Party finds itself in. And most people think that speaks to the failure of this party not to secure a bigger majority in the House or any majority whatsoever in the Senate. You talked about soul-searching. So can you be more specific about what that actually means? What do you think? And I'll go back to the question we started the conversation with. What went wrong? What needs to change? What does that soul-searching actually involve?
Well, look, again, I'm an optimist. I think to say when you take the majority what went wrong, I think you have to give a little bit of credit to the candidates, the excellent candidates who did win and who did beat incumbent Democrats. And look at those candidates. What was the characteristics of those candidates? Those candidates were optimistic. They believed in America. They were patriotic. They believed in free enterprise as the solution, not the problem. They recognized that the government and fiscal policies and policy errors are why we have this inflation crisis. And they have solutions, and they offered solutions in the form of the commitment to America, to stop the overspending, to produce American energy again, to fund, not defund the police, to make sure we have law and order in our country again, and to secure our southern border, and to say, look, we are a nation of immigrants, but we're also a nation of laws. And I think the candidates that had that positive message were the candidates that had a more divisive message and were only about opposition as opposed to policy solutions. Those candidates struggled. So I believe in a Republican Party that presents a positive message about free enterprise, freedom, liberty, limited government, and upward mobility. That's how we're going to win the majority for the years to come.
Congressman, we're going to have a longer conversation about your role on the House Subcommittee on Oversight and Investigation in the next couple of weeks, and I'm looking forward to that conversation. Andy Barr there, Republican from Kentucky. Live from New York City, equity futures higher. From New York City this morning, good morning.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists, because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
There's this downside of where we are, but there's also this incredible upside. People are chasing fusion. They're chasing green, blue hydrogen. They're chasing battery storage. Something's going to break through.
Bloomberg, your global business authority.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
The underlying inflation numbers look like they're beginning to peak, which is the good news.
We've got these views around sticky inflation, recession. It's timing that, trading that. That's going to be hard.
It does feel like the market's moving data point to data point at this time.
There's a lot of people who think the Fed moves have been exaggerated.
I think markets are wrong in terms of the longevity of how long the Fed can keep rates at these elevated levels.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK back in tomorrow morning. Equities ripping once again. The rally continues. It resumes, if you will, at 1% on the S&P 500. The earnings behind us. We've heard from Home Depot, heard from Walmart in the last hour as well. Walmart in the pre-market, Lisa, up more than 7%.
And this is because they came in less bad than expected. They increased their forecast to negative 6 points to 7%, rather than the expected negative 9 to 11%. If you look at just sort of where we are, you've asked this question. I think it's the most important one for us to sit on. Is this good news or is this bad news for our economy? You're laughing, I know, because it's good news, it's bad news. It's a way to confuse the issue at 8 a.m. Eastern.
Is Walmart good news and is that bad news?
Well, is that
I asked it. I'm with you. People are asking that question this morning.
It's important. And also we've had this complete narrative shift with respect to CPI that came in less hot than expected last week, still at 7.7%. Today, in about a half an hour, we get PPI. And then we get the producer prices. Do we get a sense, a confirmation of that CPI print? And if we don't, could that be a massively market-moving type of event if people have to rethink how quickly inflation is decelerating?
It's the road towards year-end. PPI will get that out of the way with. Then on the 2nd, December 2nd, you get payrolls. The 13th, you get CPI. The 14th of December, you get the Fed meeting and the projections for next year. What's in those projections? We're waiting to see if that 23 dot gets knocked up again, and ultimately by how much, and Chairman Powell told us it would. In the last SEP, the last set of projections, that dot for 23 went from 380 to 460. I think we're expecting it now to go maybe from 460 to 5. Isn't the market basically already there? Isn't that the story? Aren't they just validating what's already in the projections and where the market already is?
I keep going back to these basic tenets of the economy that we do not understand, whether it's inflation, how much is supply driven, how much is demand driven. Some people saying demand side is about 60% of the inflation. Okay, well then how quickly are savings coming down? How much is this a tale of two incomes, of the people, the haves and the have-nots? So many questions that make it very difficult to come up with some sort of global overarching overarching thesis heading into year end.
Anne-Marie's going to be catching up with my part of the administration over in Bali. Looking forward to that conversation. That's going to come up in the next segment. We'll talk about the G20. Also need to talk about some of the feedback we're getting from the likes of Neil Dutta of Renaissance Macro this morning. This was a quote from him. Recessions work through an element of surprise. What if recession has been widely expected but growth is picking up? He goes on to say, at the moment, consumer spending is running 4% in real terms. That's the pushback this morning, Lisa, against some of the gloom. Because I get a lot of guests, and Neil's heard the same thing, saying exactly the same thing going into next year.
The surprise is that we have not seen inflation like this. The surprise will be that we don't understand how quickly it comes down. The surprise is we don't know what's going to happen with the weather or with natural gas or with Europe or with China relationships with the U.S. There are many surprises out there. How do you accurately gauge them out? People are very aware of the vulnerabilities. What they are not aware of is how things do develop over time in an environment that is, to use Tom's word, unique.
Citi, Morgan Stanley, Mike Wilson, Stuart Kaiser talking about the same thing. There is an investable window where inflation starts rolling over, and then further down the road somewhere, growth gets smacked around as well. In between, Mike Wilson says, you can dream. So we're going to trade on lower rates, a weaker dollar, the idea the Fed backs away, and then somewhere down the road, you have to trade on the Y. Not just because yields are down, the dollar's weaker, or maybe the Federal Reserve's backed off. You have to trade on the Y, that yields are lower and the Fed's backed off, and that's a growth story. But what I've seen over the last few weeks, the last few months, is that this has got closer, inflation's rolling over, good news, at least decelerating, and this has got further away. Just the idea that growth is going to get smashed to pieces. That seems to be pushed out to early 23.
Yeah, people are talking now about the likelihood of some sort of soft landing. Look, I'm not going to stop people from dreaming. Dream. Go ahead, dream. But there is this feeling right now, especially with cash piles, especially with some of the options positioning, it is recognized as just that, and this feels temporary in nature.
Isn't that just what markets are, though? Equity markets, an anticipatory asset class. Isn't it just about a dream of a better future? Isn't that what equities are?
Are we really here
today? And the gloom and doom
Tuesday?
of fixed income is about the here and now when it comes to credit. Do I get paid?
Which is the reason why people call people who focus on the credit markets pessimists. Other people would call it realist because they have to look at the actual balance sheet. And so far, the balance sheets look okay, but credit is where I'm watching for next year.
Equity futures right now at 1% on the S&P 500. Yields lower, the dollar weaker. It's a better tone in this market this Tuesday morning going into PPI in about 25 minutes' time. Scott Clemens joins us now, Chief Investment Strategist at Brown Brothers Harriman. Scott, you're talking about this consumer-driven recession. Scott, the number one question, trillion-dollar question, how far down the road is it? And are you starting to see signs of it building right now?
I think we're seeing signs building right now. I love Lisa's phrase at the top of the hour that less bad than expected is enough to move markets. I think the phrase for consumers going into 2023, though, may be less good than expected. And I mean that in the sense of the labor market's not likely to be as much of a tailwind as it has been in the past. The housing market has already begun to soften. Measures of consumer sentiment are pretty weak. And most of the excess savings generated during the pandemic have largely been spent. I don't know if that shapes up to a recession or a soft landing. Whatever it is in 2023, I think it's relatively mild. And Jonathan, to your point, it's investable.
Okay, so where do you invest?
Well, I think, Lisa, right now it's to be in equities, broadly speaking. We forget sometimes, but we have to remind our clients and our listeners that equity markets are anticipatory mechanisms. They're discounting mechanisms. And if you go back and look at the history of recessions in this country, going back to the Second World War, there have been 12 of them, according to the NBER, and maybe a 13th looming in 2023. In 9 out of 12 of those historical examples, equities are higher 1 year following the beginning of the recession, not the end. And what you see in that is the classic example of investors not making decisions based on today's headlines, but allocating capital based on today's valuations, plus an anticipation of what headlines are likely to be. You mentioned the futures market, and yes, Jonathan, you're right. The futures market is pricing in now the Fed funds sort of peaking out at about 5%. But if you look out to the end of next year, the futures market is already pricing in a couple of interest rate cuts in the tail end of 2023. That would be consistent with a relatively mild recession, and investors will invest well ahead of that anticipation if that begins to play out.
Before we get into the idea of a Fed pivot or some sort of cuts heading into the end of next year, just on the overall historical corollary, just how relevant is it given the shift in the composition, given that big tech is facing somewhat of an existential crisis when you take a look at Meta, for example, which has been losing popularity, and some of the other names that have really struggled for real reasons that are not necessarily just because of the cycle?
Lisa, I think it's still relevant. And I think it's the old Mark Twain observation that history may not repeat itself, but it rhymes. We're certainly in a market that's largely dominated by tech. But if you look back at previous cycles, there's always one sector that tends to dominate the market. It's been financials in the past. It's been energy many, many years ago. So at the risk of employing the old cliche, I do think that 2023 will be a stock picker's market. And let me illustrate that. So you look at the overall S&P trading at, let's call it 17 or 18 times earnings. If you break down and look at the individual constituents within the S&P, close to 100 constituents of the index are trading at single-digit multiples. How can that be? Obviously, the averages are dragged upward by the rather lofty valuations on large cap technology. So again, it's a cliche, but I think it's a cliche that's applicable in this market, that 2023 is likely to be a stock picker's paradise.
Scott Clements, thank you, sir. We're going to talk about that stock picker's paradise going into year end and in early 2023 to see if that's actually the case or not in early 23. We've heard that a lot, haven't we? And not just over the last 6 months, we've heard that over the last 10 years. And what happened over the last 10 years? Passive investing absolutely dominated. Index level, hug it, great returns, largely because of the weightings, massive weighting towards big tech growth names, which are delivered in a massive way. Those names have now bumped into some real trouble, which validates, supports perhaps the story that Scott's talking about, and it's why he's not the only one pushing it.
The problem is that some of these companies do face more substantial problems than others. And it doesn't feel like they're going to get turned around by simply a better time or a monetary policy shift, right? So the question is the change more significant facing the likes of a Meta or like really even a Netflix, given the competition? Or is this simply just a case of valuations that will reassert itself next year when people start thinking about rate cuts again?
In good times, when rates are low, it's always about the promise of growth in the future. You don't have to turn a massive profit, don't have to turn one at all. Just the promise of more and more growth, more and more growth. Long duration assets, fantastic. What's happened now? 4%, the discipline of 4%, the threat of 5%. Cut costs, show me the money, show me the profit. That's what's really haunting some of these names. And it's why you're seeing cuts now at companies you would just never have seen cuts at 5 years ago.
Amazon, yeah, look at that 10,000 people cut. And this is corporate and tech jobs, not just necessarily jobs tied to warehouse workers or sort of seasonal trends. This is people who work on the Echo, people who work on Alexa. This is people really who are in some of the nuts and bolts of some of the areas that were thought of as some of the more promising ones.
Did you get an Alexa?
I did.
Did you? What do you do with it?
I talk to it. Actually,
you talk to it? What do you say to it?
Well, full story, true story. My kids like to ask it to tell it jokes because they tell jokes that.
Oh, okay, good jokes.
Some of them are good, some of them are really bad, and then we laugh. And the weather, how it's doing. You could ask lots of questions. They actually have some really.
You're in conversation with a robot. It's amazing.
Sometimes it just.
Do you enjoy that?
Not particularly, no.
Amazing. Equity futures this morning positive. On Walmart, we're up by more than 7%. Lisa's got a couple of minutes to pull us out together. We're going to hand it over to Anne-Marie in just a moment over in Bali. She's at the G20. She's with a White House official. Looking forward to that conversation. We'll get you that in just a moment. Live from New York, this is Bloomberg.
And Alexa actually on my Christmas list. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Former President Trump is set to announce he's running for the White House again. The announcement will come tonight at his Mar-a-Lago club in Florida. But Citadel's billionaire founder, Ken Griffin, thinks Republicans should look elsewhere.
He lost in 2020. We lost Georgia because of his behavior in the Senate race in 2020. That's a second loss. And then this year, the Republicans lost the Senate because the Trump-backed candidates in the Senate races were rejected by American voters. That's a three-time loser. And I'd like to think that the Republican Party is ready to move on from somebody who's been, for this party, a three-time loser.
Griffin supports Florida Governor Ron DeSantis. Now, he spoke at the Bloomberg New Economy Forum in Singapore. In Arizona, Democrat Katie Hobbs has turned back a prominent election denier to be elected governor. Hobbs defeated Republican Kari Lake, who embraced Donald Trump's baseless claims of fraud in the 2020 election. The Associated Press called the race with about 98% of the ballots counted. Hobbs has a more than 20,000 vote lead. Shares of Walmart are rising today. The retail giant raised its outlook after strong quarterly sales. Walmart also announced a new 20 billion share repurchase plan. The company said it has significantly improved its inventory position, and it continues to gain market share in U.S. grocery business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority.
of an iceberg in terms of layoffs. And of course, we think layoffs will increase next year, but what I expect will happen in 2023 is really a slow motion realization that we are going into a recession and that earnings are going to come off.
Dussel there, Linda Dussel, the senior equity strategist at Federated Hermes. Walmart this morning is the one to watch, up by 7.5%. Equity futures up by more than 1 percentage point this morning. This market's doing nicely, 1 hour and 12 minutes away from the opening bell and about 12 minutes away from PPI numbers in America. We'll break that down for you in just a moment. Tweet of the morning from Steve Murray out on Twitter. Lisa needs a break from Keenan Farrow so bad she goes home and talks to a machine.
Hi, Alexa.
Isn't that perfect?
How's it going?
Please save me from Bloomberg surveillance. Anne-Marie's going to save you now. AMH joins us now from Bali with a special guest. Hey, Anne-Marie.
Thanks so much, John. The fact that this guest is with me does sound like things are looking hopeful for the joint communique that leaders we're going to sign off for. I'm joined now by the President's Deputy National Security Advisor, Mike Pyle. Mike, thanks so much for joining me. You're the representative at the table, what they call in the G20 speak, the Sherpa. And the fact that you're here at 8:15 Bali night before the leaders sign off on it, it sounds like it's hopeful that all 20 leaders will sign this communique. How were you able to get Russia on board?
So I don't want to get ahead of our leaders. Obviously, they will speak collectively coming out of the summit. But I think we're constructive that there's going to be a statement from the G20 that accomplishes what the president set out as his priorities coming in. You know, number one, to rally the world to speak in strong language around Russia's war in Ukraine, to condemn Russia, to condemn the consequences of Russia's behavior in terms of its stresses on the global economy, but then also to present to the world an affirmative vision for what an action plan could look like to address those stresses, particularly on vulnerable countries in the emerging world.
How crucial was Xi Jinping in China to getting this communique over the finish line?
So I think you know, what I would say is, you know, President Biden and his vision was very essential to getting this communique over the finish line. Again, one, you know, coming in and working hard to rally a broad stretch of the G20. I think what you'll see in the communique when it's released is that most of the G20 came together to strongly condemn Russia's war, to strongly condemn those actions and the consequences that's had for the global economy. And you're also going to see reflected in that a lot of the priorities that the president's articulated, whether it's the need for reform at the multilateral development banks like the World Bank, whether that's the need to stand up an effort to be more prepared for future pandemics, whether that's an issue like debt relief, where, again, like what we saw in October, one country out of the 20 was isolated while the rest of the 19 stood up and said, this is something we need to do to help vulnerable countries. I think you're going to see those priorities in the communique, and I think that's a reflection of U.S. leadership.
We're hearing a growing chorus on the margins or out in the front about some actions the United States has taken. One, the Inflation Reduction Act, giving subsidies to American companies, but also the curbs on chips to China, where potentially a European company like ASML in the Netherlands might get caught in the crossfires between what the United States does not want to happen, been selling to China. How have you been able to deal with your allies in these two critical issues that are going to help the U.S. domestically and is going to hurt them?
So with respect to the IRA, I mean, I think the core point is we have a shared challenge globally around climate change. And we have heard from the rest of the world for years the United States needs to take major action to address that risk, to address this problem that we all face. And this is historic action that has never been taken before in the United States at this scale.
Macron called it unfriendly, though.
Well, again, I would say, with respect to what is the core global challenge that we face of climate change, this is historic action that will further the U.S.'s achievement of its climate goals, and the U.S. achieving its climate goals is essential to the world achieving its climate goals. The other thing I would say is, you know, the investments that we're making in clean energy, in electric vehicles, you know, really are investments that you can't make enough of. And we invite other countries to similarly make investments in their own clean energy sector, in their own secure battery supply chains. These are things that we think that we can do in a way that is going to serve everyone's interests. And the United States has taken a huge step forward to do that for our economy and for the rest of the world.
The president obviously came into this meeting with all these leaders with a pretty much a big boost in his step, in the sense that the Democrats are able to maintain control of the Senate, even though we still don't know what's going on with Georgia, and the red wave really was a red ripple. Do you think if that outcome was different, it would have changed the meetings and how the president was perceived here on the ground?
So I'm the economics guy, not the politics guy, but
But the world right now, the economy and politics are everything when a country's dealing with sky-high inflation and the likes.
I think that, as I said before, U.S. leadership, the president's leadership was on full display. I think they see a U.S. economy that is resilient in the face of global challenges. They see a president and an administration that have delivered on their promises in terms of reinvesting in the U.S. economy, in terms of taking historic action on climate change. And I think as a result of that leadership, a lot of the things that I described as our agenda coming into this, the president's agenda coming into this, really met with a lot of open ears and open arms from most of the G20.
Mike Pyle, thank you so much for joining me and Bloomberg Television. John, Lisa, that was President Biden's Deputy National Security Advisor, Mike Pyle. In the G20 speak, he is the Sherpa. He represents the U.S. interest at the table as they go through every single issue that they're going to sign off on this communique. And at the moment, it does look they are going to get all, or at least the majority, of leaders on board.
It makes great work, not just this morning, but over the last couple of days as well. Anne-Marie Jourdain there. Lisa, as you know, and many people know who follow the G20 and events like this, I joke about the dinner. So much work goes into this from people like Mike Pyle, who spend months, weeks, months, going over this with other leaders, other representatives of leaders, to put through maybe about 3/4 of ultimately what's agreed, and then the last 25% is the leaders trying to hash out things to get over the finish line. I think if we managed to get a communique from this G20, given how low the bar was, given how difficult it is to get 20 countries to agree on anything right now, I think that's probably quite a win.
And to your point, this is the reason why it was a big headline that Xi Jinping and President Biden shook hands, because the sort of photo op is the main point of this. The bulk of the work is done before that, and then it's coming together and displaying what that work has yielded. And what that has yielded is something that is a little less scary than what some people were imagining, perhaps, about 6 months ago.
Would you like to know what I'm working on the Bloomberg terminal?
I would.
BRKT space WCUP. So that's BRKT space WCUP. That is your World Cup bracket code for Bloomberg Terminal subscribers. You're going to do one. This is why Tom's actually off.
Yeah, I was about to say.
TK spent the last 2 days doing his World Cup bracket. You're going to do one?
I think of it. I'm going to have to. I'm going to have to. I'm going to really get into it. I'm going to really
I'm really bad at this.
Really?
Yes. Very, very bad at this. And I think last time, did I lose to Tom? I'm pretty sure I lost to Tom 4 years ago.
Which tells you pretty much all you need to know.
I was terrible
at it. I will participate, and now I know what you've been working on in the breaks.
Why I'm so distracted.
You're so distracted.
Live on air too, from New York. This is Bloomberg.
do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
CPI last week delivered a downside surprise. You get PPI in just a moment from now, seconds away. Mike McKee's going to break that down. Going into the data point, equity futures just about positive, nicely positive, at more than 1% on the S&P 500. Yields lower by 3 or 4 basis points. And equities spike higher, Mike McKee. Give us the why.
Well, it looks like we're coming in with a little bit lighter PPI, up 0.2% on final demand month over month, and core is flat on the month, which is down from a 0.3 gain the month before. Take out food and energy on a year-over-year basis, and you are up 6.7%. That's a big drop from 7.2%, and the headline is at 8, down from 8.5. So significantly good news on the PPI, which trails CPI. They're not directly comparable. There are middlemen in the middle, but that is particularly good news. We also have good news from the Empire manufacturing numbers. It's kind of the first one out of the Fed regionals, and they are up 14 points to 4.5. New orders down a little. Inventory's up a lot, but employment is up. We're still seeing strong labor markets. Prices paid, little change, 50.5. Prices received, 27.2, is up 4 points. So not as good an economic, shall we say, inflation story on the Empire manufacturing, but the PPI comes in echoing what we saw the CPI.
Another green light to buy equities, for now at least. Let's see if this move sticks. On the S&P 500, futures up by 1.7%. So just off session highs coming off the back of this number. Yields lower. Much, much lower. Starting at the belly of the curve, the 5-year down 11 basis points, the 10-year down 9. Your 10-year yield right now just south of 377. On a 2-year, we're down 6 basis points to about 433. So yields are down, the dollar's weaker, and equities are up on this downside surprise on PPI. Mike, you and I talked about a Fed speak when it started with Patrick Harker last week of the Philadelphia Fed. He said inflation was up like a rocket, and you said it was down like a feather. How fast can this fall?
It can fall like a rocket. Maybe one of Elon Musk's rockets that just,
sort of lands itself nicely. Is that the ultimate soft landing?
This is a very unusual inflation cycle. It went up very quickly because of a whole confluence of forces. And so it could come down much more quickly. I think what you'll get is a lot of the stuff that was cyclical goes out of it fairly quickly. and then we start to see it slow down as we get some secular kinds of inflation in there. Good question to ask, not that you ever have any guests on TV to talk to, but is what do people think is going to happen after this? Do we go back to the new normal of low inflation, low interest rates, low growth, or do we stick with a higher level of inflation, which means higher interest rates, and how does that affect everything?
We'll definitely keep asking that. Looking just at this data, one thing that people were expecting was that services side inflation would continue to come in hotter, even if you did see some sort of mitigation in the inflationary impulse on the goods side. Are we seeing that in the details?
No, the services, final demand for services up 0.4 after a 0.3 gain in August, but it's not. It's not the end of the world here. We're still seeing very small gains. Actually, I had that wrong. Final demand for services down 0.1, first decline since November 2020. So
wow.
I was wrong, but I was wrong. When I'm wrong, it's good news for the overall economy. Margins for final demand trade services fell 0.5%, which is basically wholesaler and retailer margins. And so their ability to maintain their margins going down, that brings down inflation overall. But you can think about that in terms of what it means for earnings, too.
Vice Chair Brainerd talked about that, scope for margins to come in and inflation to come back down. S&P 500 futures right now at 2%. I've got the NASDAQ up more than 3 percentage points. This rally over the last week has been phenomenal. We build on it this morning off the back of a softer than expected PPI number. Joining us now to discuss, I'm pleased to say, is Rob Arnott, the Chairman of Research Affiliates. Rob, can we just start with a story Mike and I were discussing? How quickly can inflation come back down towards target?
Inflation can come back down quite quickly, but history suggests that that's an outlier, that when you get inflation above 8%, we did a study that we published yesterday looking at 14 developed economies around the world going back over the last 50 years. There were 52 instances of inflation rising above 4%. And we asked, how quickly does it recede? And many of them went on to 6%, over 30 of them went on to 6%, over 25 went on to 8%. And when you get to 8% inflation, there's two possibilities. You've hit the high, it rolls over and comes down. How quickly? On average, it takes 2 years for it to come back down to 4%. That's not bad. That's not as quickly as people would like, but that's the median, just to 4%, 2.5 years to 3%, 5 years to get back down to 2%. If this is not the high, if you move on to new levels of inflation, 10% or higher, then it takes an average of 10 years to get back down to 4%. So the good news is there's a distinct possibility we'll see inflation moderate fairly quickly. The bad news is there's a distinct possibility, roughly equally likely, that it could take 10 years. This is the unfortunate reality of inflation.
Rob, right now we're seeing markets very excited about the idea of some sort of slowdown in the pace of inflation, some sort of disinflationary impulse. Do you think that the market stocks are getting a little ahead of themselves in terms of pricing in Fed rate cuts as soon as late next year and some sort of softer landing type of scenario?
Well, of course, that scenario, as I said, is entirely possible. The market is pricing it in as if it's the midpoint expectation. And the midpoint expectation should include scenarios where it does move to new highs and scenarios where it eases off fairly quickly. But most people think in terms of getting to 4% by middle of next year as a reasonable expectation. That's an outlier. That's in the 10% most benign outcomes. The 20% most benign, it takes 2 years to get down to 4%. The 20% most least benign, it takes 10 years or more. And that scenario deserves some acknowledgement because it could happen.
What would that look like in terms of market read-through? Is that the lost decade for U.S. stocks?
That's exactly right. What we would have is a lost decade for stocks and bonds. There's no way that bond yields could stay in the 4% range if inflation takes 10 years to get back down to 4%. So please don't misunderstand me as saying that I think it'll take 10 years. I'm not saying that. I'm saying we should acknowledge the possibility that it could take multiple years. What we're doing, money can't serve multiple masters. It's a medium of exchange to buy or sell labor, goods, or services. Either contemporaneously, I exchange my investment advice for groceries, indirectly by way of using money, or intertemporally, the store of value for money. Money can't serve multiple masters. Central bankers seem eager to promote an array of goals. They hope to achieve, through monetary policy, price stability, full employment, low servicing costs for government debt, bear market disruption, preventing bear markets, and so forth. When money is asked to serve multiple masters, it doesn't serve any of them particularly well. And that's a simple truism that is too easily overlooked.
Hey, Rob, always a clinic. Appreciate your time this morning, sir. Rob Arnott there of Research Affiliates off the back of a softer than expected PPI. Here's your recipe for a massive rally in the equity market, up another 3% on the NASDAQ, on the S&P 500, up in and around 2%. We had a downside surprise on CPI. We've got a downside surprise on PPI. There is a hope that we get more China reopening. There was a hope for gridlock. It looks like, Bramo, we're getting gridlock. Put it all together, stir it into a pot, and what have you got? Buy equities. Let's see if it sticks going into year end.
Interestingly, Jonathan Golub of Credit Suisse, who typically is a stock market bull, highlights this incredible move that we've seen. Stocks are up about almost 11% since mid-October, and he talked about how most of it was before the CPI print last week, basically saying that he thinks that the market's near-term potential is more limited because of how much has already been baked in. Is that going to be the consensus that we hear from so many other people as well?
This is what Mike Wilson thinks as well. He's been leaning into this, what they call a tactical bear market rally, but ultimately expecting some real lows in the first quarter of next year off the back of some bad numbers going into year end.
Because of what Rob Arnott was talking about, too, what are we pricing in? How much are we accurately accounting for the risk of something more substantial, a slowdown, if we don't have a sense of really how far and how quickly inflation can keep coming down?
I'll stay on top of the story going into the opening bound. Coming up on the open, we're going to catch up with a range of guests to break down this move, including Jared Woodard of Bank of America and Peter Cicchini of Exonic. Looking forward to that conversation. Before we get there, I've got to get you some breaking news on Goldman. Some of the news has been brought to you by Sri Natarajan, who joins us right now. Sri, can you run us through what you've learned around Goldman Sachs, please, sir?
Yes, John. We just had a story today on how Goldman Sachs paid well over $12 million to a veteran executive who, on the way out, complained about a culture of sexism at the bank. That is interesting because we rarely get a peek into a settlement like that, and we rarely get a complaint for someone as senior as that in the industry. To make it into the Goldman partnership is extremely rare. To be willing to then air your ugliest experiences is rarer still. Of course, this was an internal complaint. There were settlements and a non-disclosure agreement, so none of this is public. But based on what we have now, it does seem that the sum was willing to settle for a pretty significant amount, a high 8-figure payout, to make sure some of these embarrassing details did not come out. It included stuff about lewd and ugly and vulgar dismissive remarks made by senior managers at the firm, allegations of pay disparity, and even lack of promotion for women. Taken together, clearly there was a recipe for something that was not going to look good for Goldman Sachs, and they decided to move ahead and make sure that they could bury the complaint and it never became public.
What's the significance, Sri, of this coming out now in terms of either a culture shift or exposing what's been going on as some of the lip service is paid to a culture shift?
And that's important, Lisa, because when this happened, as we understand, this was 2 years ago in 2020. Most of the incidents described in the complaint were from 2018 and 2019. So this is not from some prehistoric era on Wall Street. This was all pretty recent. And if you look at some of the complaints there, the way the allegations are made here about how women were treated, critiquing their weight and looks, suggesting fitness regimens, comparing them to flight crew in gender research meetings, tells you all is not well. And you can understand why that's problematic for a firm like Goldman Sachs, for that to possibly come out when you are going out there, when you have a leadership team that, to their credit, has made diversity a key plank of their tenure. They have been wanting to tout their credentials on that front. And therefore, when you have something like this, that is a little troubling. Is it completely out of whack from what we've heard on Wall Street and the experience of women of Wall Street in the industry? Not true. veterans of the industry are inured to such stock because they are pretty much used to it on a regular basis. But still, this settlement gives you a window into the price for secrecy, what a firm may be willing to pay to make sure such claims never become public.
Sridhar Natarajan of Bloomberg News, thank you so much, and congratulations on the story that really highlights some of the parts of Wall Street that a lot of people have typically kept pretty secret. Right now, just turning to the markets after that PPI report, the second straight softer than expected inflationary read, sending stocks much higher. I'm looking at a NASDAQ now, up nearly 3% in pre-market trading on top of what we saw over the past month or so. Since mid-October, we've seen a real rip higher, and it continues today. We're seeing yields lower as people take a look at the potential for perhaps a little bit more likelihood of a soft landing. I'm looking right now at a 5-year yield, U.S. Treasury yield at 3.89%. That is the lowest going back about a month. So we are seeing that also there since the beginning of October. We're seeing the dollar continue to weaken. Again, a strong euro, 104.53. And the VIX has just torn down as people expect perhaps a bit of a softer ride going forward. Coming up, we get to have more conversation about how to position in this environment. This is Bloomberg.
NEC was started under President Clinton, and Bob Rubin was the first person to hold that job. Can you explain to people what it actually does and what the NEC does day to day? When, for example, who's in the NEC, who's on the NEC, what is your job actually to do?
So the National Economic Council, the job, the mandate, the mission of the organization is to coordinate economic policy across the executive branch and across the cabinet to make sure that the president is getting the benefit of when making decisions of his entire economic cabinet, and also that the economic cabinet is getting clear direction from the president as well. So that two ways. So it's a coordination function. On the NEC itself are all of the relevant cabinet members, the sort of core economic team, OMB, Council of Economic Advisors, Treasury, but also Secretary of Labor, Secretary of Commerce. My team, the NEC team, is a small team within the White House that is, our job is to do that coordination across the range of economic policy issues.
Now, you were the deputy in the Obama administration at the NEC, now you're the director. Which NEC worked better, the Obama administration one or the Biden one?
Well, on the issues that I worked on in the Obama administration, it worked very, very well. And the current NEC works very well as well.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
We have to be rational in terms of how financial conditions can evolve, how eventually we can get to a point that the Federal Reserve will perhaps entertain, supporting growth instead of inflation. But that seems to be a little bit premature at this point.
Jerome Schneider, head of short-term portfolio management at PIMCO, perhaps premature. However, right now in markets, people seem to be cheering the end of inflation, at least the end of inflation as it had been in terms of how hot it was. We got the second consecutive downside surprise, a good surprise when it comes to softer than expected inflation and PPI coming in lighter than expected across the board, coming in at 8% versus 8.3%. If you strip out food and energy, 6.7% as opposed to expectations for 7.2%. The response in markets quite clear. Rally across the board. S&P up 1.8%. The NASDAQ up quite a bit more, almost 3%. Yields lower, dollar weaker. Across the board, a more sanguine picture for people who want to take risk. Joining us now is someone who has a really critical view on the whole issue. Jurrien Timmer, Global Macro Director at Fidelity Investments. And Jurrien, I take a look at this and I think about something that you wrote. Today, I can sum up the outlook in only 14 words. I like this. The Fed is solving for 2% inflation. The market is solving for the Fed. Is this market entirely looking to the Fed, and a day like today is just betting the Fed will not have to raise rates as high and keep them there as long?
I think that's true, and I think the market is feeling more confident, if you will, that it can look past peak Fed, whether that's 5% or 5.25% or 4.75%, and onto a more neutral kind of zone that will presumably come after the peak, which will be early next year, and then towards 2024. So if that neutral zone is 3.5%, and you put in the math of where the 2-year yield is, where 10-year real yields are, you plug that into a discounted cash flow model, you get to the kind of levels that we're now seeing in the market. So I think the CPI and now the PPI reports give the market some confidence that finally we can look past this peak in the curve and onto a more sort of normal range of interest rates. And that's how you get from 14 or 15 times earnings, which was really kind of the fair value when the 2-year yield was at 4.7 instead of now in the low 4s, and onto a 17 type of multiple. Whether we can get beyond that, of course, is the big question.
Are markets overly rosy right now?
I don't think they're overly rosy, but that doesn't mean they have a lot more room to rally from here, because at a 17 multiple, which is kind of where we are now, and that's assuming that earnings, of course, hold, which, of course, is a very big assumption. I think we've already discounted a return to some kind of normalcy in interest rates. So in order to get another leg up from here, I think there would have to be more visibility that earnings are not going to fall, and then the market can have some comfort in the denominator of the PE. But also the Fed might start to throw cold water on this rally, because what happens when stocks rally and bonds rally and the dollar goes down? Financial conditions loosen, which is the opposite of what the Fed wants to see during a tightening campaign, because it wants financial conditions to tighten. So another risk is that the Fed will start throwing cold water on this rally.
How much do you have to look to big tech? And I keep coming back to this because it's such a significant component of the overall indexes. If there isn't something more structural about how they operate that gives people confidence, can we see the S&P end up positive next year versus where we are today?
It's possible, but what I call the Nifty 50, the big mega cap growth stocks, those have been a powerful engine for the markets over the past 10 years or so, right? They generate a lot of free cash flow. A lot of that cash flow that was extra was returned back to shareholders via share buybacks. And that financial engineering machine has been very, very rewarding for investors, because it creates a high payout ratio, right? More earnings are returned to shareholders directly via dividends or indirectly via buybacks. But clearly there's been pressure on those mega cap growth names. We've seen that this year. Most of them are down significantly. and they rely on a very low cost of capital in order to compound that very long duration stream of cash flows. So it's a big open question as to whether that can continue, and the rotation we're now seeing, right, towards value, towards small caps even, that could have some legs.
How hard was it to come up with the 2023 outlook?
It's hard because there are so many moving targets, but really right now, it is about the Fed. The Fed has made it clear that it's not just inflation coming down that they're after, but they want inflation back to 2%, or 2% tends to be on the core PCE that they look at mostly. So that's about 2.5 on the CPI, and we're still at around 8%. So from 8 to 2.5 is going to take some time. It might happen fast in terms of getting from 8 to 4. I think that part will be relatively easy, as your previous guest indicated, just from base effects. But it has to go all the way to 2 for the Fed to be able to truly, step off the brakes and allow for a neutral policy. And that's a question for the back end of this cycle, a year from now or 6 months from now, and it'll be the biggest variable for 2023.
If it's all about the Fed, what's your biggest conviction, considering that there's a lot of uncertainty right now around the Fed?
My biggest conviction has evolved because a year ago, I would have said, and I did say, that the Fed has a dual mandate: full employment, price stability, 2% inflation. And I said that if inflation goes to only 3, let's say, inflation back, the Fed would kind of tolerate above target inflation in order to keep employment at full capacity. From what I'm hearing and seeing, and from talking to former Fed officials, the Fed is going to sacrifice the economy if it needs to in order to get inflation not just down from where it is, but all the way down to 2. So I think a Fed that is maybe more hawkish than we've all kind of come to think over the last few years, after all the monetary stimulus we got during COVID, I think is probably one of the highest convictions themes out there right now.
Just quickly, what does that mean for markets? What does that mean for market calls?
It keeps a lid on valuations. Earnings are holding up, although that's mostly in nominal terms, right? So there's a money illusion from inflation. And when you go back historically, you see inflationary recessions. Earnings tend to hold up okay, but it puts a ceiling on how far the PE can go. And whether it's 17 or 18, I don't know, but there is a limit to that.
And we're getting close to that limit.
Yes, I think so.
Jurrien Timmer, thank you so much for taking the time and for being here in studio with us. Jurrien Timmer of Fidelity Investments joining us. And just to his point about on nominal levels, you're seeing growth hang in there. Home Depot, a prime example of this, coming out earlier this morning with results that beat estimates on the top line. But when you dig under the surface, it looks like there were some traffic declines, and people see that perhaps this is mostly on a nominal term and not necessarily on a fundamental comparative store basis, that those shares lower by about 0.6% in pre-market trading. The rest of the market ripping higher as a result of the second consecutive weaker than expected, softer than expected inflationary print. You're seeing the S&P up 1.8%, the euro climbing versus the euro 104.33, and you can see those yields heading lower. The 10-year yield 3.79%, the lowest going back to the beginning of October. The dollar, if you look at the dollar spot index, the lowest going back to August. Coming up on Balance of Power on Bloomberg TV and radio, Sir Peter Westmacott, former UK ambassador to the U.S. This is Bloomberg.
I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
There's this downside of where we are, but there's also this incredible upside. People are chasing fusion. They're chasing green, blue hydrogen. They're chasing battery storage. Something's going to break through.
Bloomberg, your global business authority.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
The equity bulls are getting it their way, that's for sure right now. Live from New York City this morning. Good morning, good morning. PPI downside surprise, equity market higher, much higher. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, we begin with the big issue. For how long can investors dream?
The key issue at the moment is the sequencing of hitting the Fed's dual mandate. So the sequencing happens to be in the right way for markets, namely, first inflation is coming down. We have seen now inflation come down from the peak in June without an increase in the unemployment rate.
Looking for a sweet spot between inflation rolling over and growth getting smashed. Citi's Stuart Kaiser saying time is running out.
The investable windows are really, really short. It's the window between, hey, inflation looks like it's peaked, the Fed can back off on rate hikes, and the unemployment rate is rising and other forms of economic growth are slowing.
Morgan Stanley's Mike Wilson putting an end date on that dream, bracing for the growth shock to hit in Q1.
The earnings forecasts for next year are substantially too high. That process of readjusting those estimates will begin in the fourth quarter reporting season because that's when companies will have to address 2023 forecast, which they haven't done yet. And that's the catalyst. It's basically the slowdown that will hit earnings significantly next year.
Joining us right now to discuss is Bank of America's Jared Woodard and Exonic's Peter Cecchini. Jared, I want to begin with you and go to that quote from Stuart Kaiser over at Citi. That sweet spot for markets. Timing matters for markets, he said. Would inflation crest before growth deteriorates and let the FOMC deal with those risks to its mandate separately? For markets, how long an investable window is there between those two waves of economic risks? Can you walk us through that, Jared? How wide do you think that window is?
I think it's a very narrow window, John, for investors to try to take some sort of tactical bullish trade. Really, right now, the big risk that we see is that the lags between monetary policy tightening and the effects in the real economy could be much longer than investors have priced in. Think about the mortgage market in the United States. Something like 90 or 95% of mortgages in the U.S. are fixed versus only 2/3 in the rest of the world. That means monetary policy is biting harder elsewhere, not here. The United States also only has, the only place where you saw massive fiscal stimulus, $1 trillion on the balance sheets of U.S. households in excess of historical norms. That means that rate hikes take longer to hit harder because of all that excess consumer cash. And I think you're going to see a big lag, and that means it's going to be very difficult for markets to digest both slowing growth and tighter financial conditions at the same time.
So, Jared, would you fade the move on the screen at the moment? Equity futures up 1.8% on the S&P, up much, much more on the NASDAQ.
Absolutely, John. We think this is a structural shift. We're in the very middle of, very early innings of, really, between the 2% world of the past 2 decades, 2% real GDP growth, 2% inflation targets. If you look at the broader 20th century, 5% was more the norm. And that shift from 2 to 5%, from growth stocks to value stocks, from atoms to bits, from digital to real, it's very early days, and we would use rallies like this within a bear market to take profits in growth, take profits in long-term treasuries, and rotate back to the inflation-friendly types of trades.
Pete, do you agree?
Yeah, no, I agree with Jared on this. He referred to it as a structural shift. We've referred to it as a regime shift, and I agree with it. Investors over a 40-year plus period have become quite used to that secular downtrend in both short and long rates, which was finally met with a thud at the zero bound. The other challenge that the Fed now faces is once it's done combating inflation, wherever that terminal rate ends up, whether it's 4% or higher, 5%, it will struggle with its ability to use a shock and awe strategy to get us out of whatever recession we're in at that point. And that's something that the Fed has been, pulling out of its playbook again for 40 years. So I agree with that. It is a regime change. Monetary policy is not what it was throughout most of that 40-year period. People got used to Goldilocks, and I think that's a thing of the past. I think active investing is going to do a lot better in an environment where monetary policy isn't a persistent tailwind.
When it comes to the chances of Goldilocks, I think most people agree with you. According to the Bank of America Fund Manager Survey, stagflation fears were 92% of the feedback in this survey. 92%. An overwhelming consensus in this survey. Nobody thinks Goldilocks is coming. Katie Lyons has more. Hey, Katie.
Hey, John. Yeah, the title of this survey is Stagflation. It's so hot right now because, as you just said, pretty much everyone thinks it's coming next year. And actually, 77% of respondents in this month's Fund Manager Survey think a global recession is coming. And as a result, sentiment is what Bank of America describes as still, quote, uber bearish. As for how that's reflected in allocation, investors are the most overweight cash and most underweight equities, with tech allocation actually the lowest level since 2006. And for the 5th straight month in a row, long U.S. dollar is the most crowded trade. 72% of investors say that the dollar is overvalued, which is the most on record. And then for the other crowded trades, you have number 2, short China stocks, number 3, long oil, followed by short European equities and long ESG assets. And finally, as we do every month, when you round it out, looking at the biggest tail risks, inflation staying high remains number 1. 32% of people gave that answer. And then the next 3 actually all are tied. Geopolitics worsening, hawkish central banks, and a deep global recession, each getting 18%. One could argue all of those things are really tied together. And then rounding out the list, a systemic credit event. But really, John, the takeaway of this survey is pretty much everyone sees stagflation coming.
Stagflation, so hot right now. Katie, thank you. Their title, as Katie mentioned a few times. Stagflation then, below trend growth, above trend inflation, the overwhelmingly consensus view in the Fund Manager Survey at 92%. No one thinks Goldilocks. Peter, when you hear that, does that make you uncomfortable, given the overwhelming size of the consensus going into 23?
It most certainly does. The broader the consensus, the more likely one is to be wrong. That's been my experience over my investing career. That said, this is one of the reasons why you see the kinds of rallies we've seen over the past week and change. We noted in mid-October, in fact, that breadth across indices, but in particular on the NYSE and the S&P, was about 3 standard deviations below its trend line. And that got us actually tactically constructive in mid-October, and we've actually been lightly to not hedged at all since then. But that's a tactical view within the more strategic view. which I do think, despite the fact that it's consensus, will be correct. Things are going to get worse from here.
Jared, you understand this survey better than most because you used to help put it together at BofA. I'll go through those numbers again for you. I'm sure you've read it. Stagflation, the overwhelmingly consensus view at 92%. Nobody thinks Goldilocks in a fund manager survey. When you hear stuff like that, Jared, in that survey that the team conducts over at BofA, how do you use that information?
Well, it's still a fantastic piece of work, John, even though I'm not involved. Thank you for highlighting it. It's a very important truth that's revealed there, which is that investment professionals understand the shift that's taking place. I think that the big warning from my mind is that this is not a time to get too cute. It's not a time to be too contrarian too quickly, because if we're right that we're under the very early stages of a big macroeconomic shift, then the valuation reset could be substantial and it could be prolonged. We wrote a report recently about the Nifty 50 stocks in the 1970s, which had very similar both macro and investment profiles to today. Investors had piled into these very expensive, seemingly high quality growth stocks. Valuations were sky high. The macro turned and the inflation that the Fed had to fight was very serious. And you saw valuations reset over the course of many years, not months, not quarters. And anyone who stepped in front of that freight train of a great valuation reset got burned. And I think that that's the environment that investors have to contend with today. 2 decades, $70 trillion of assets invested for a 2% world. How many analysts, how many investors have reset their valuation models, their discounted cash flow frameworks for a world with higher interest rates, higher costs of debt, higher rollovers in the bond market? And if you do those resets, you reset those models, I think you get very different valuations of where the market is today. It's not a time to fade what could be a major structural shift.
Jared, this is huge, so let's go deeper. You've gone there a few times now. I've been asking a question. Are we unwinding the excess of the last couple of years post-pandemic, or the excess of the last 10 years plus? I hear from you it's the last 10 years plus. Not many people share that view at the moment, Jared. And as you point out, that's going to have profound implications for how we value the market if Fed funds stays at 4, 5%. Let's say even if it stays in at around 3.5%, that's a major change from 10 years ago. Can you run me through, Jared, the challenges to the index level passive investing of the last decade, what those challenges will look like in the years to come, given the weightings of growth equities like big tech?
Yeah, I mean, I think that the conclusion, the big investment impact here is a rotation from the winners of the past 2 decades, which were tech stocks, consumer discretionary, think about Amazon, communications, these growth stocks that did so well in a world of record low inflation, record low interest rates, high globalization, deflationary demographics. Those secular trends are all reversing. Onshoring and globalization, demographics now inflationary, and you don't have the kind of tech disruptions that are sweeping across the economy that you did over the past 20 years. That means that those growth sector winners, I think, become the losers of the future. And who picks up the slack? Who's the new leadership? Most likely, from our view, the real economy sectors like industrials, energy, materials, maybe financials, lending into those companies. These sectors, by the way, if you look back at history, it wasn't that long ago that these sectors accounted for more than half of the market cap of the S&P 500. They've since retreated to about 10%. I think they could regain that leadership in the years to come.
Dare I say the leadership then may come abroad as well? What's your view on that, Jared?
Well, look, it's a lot of challenges in the developed world. Our economists expect a recession in Europe next year. Japan still sort of struggling along. But if you look at emerging markets, especially emerging markets ex-China, even China on a very tactical basis, very nimble basis, there's some reasons to be more optimistic. So I think it's very fair to say that given how ahead of the curve emerging market central banks have been, and central banks around the rest of the world globally, you may see a period over the next 12 months in which certain countries, certain markets actually outpace the U.S. in terms of moving through this bear market and onto the other side.
Pete, final word here, please.
Yeah, no, I think it is a new investment paradigm, and I think there's going to be plenty of opportunity in what we do, which is structured products, and in particular, I think the levered loan market is at risk here with this, alongside this interest rate reset. When you look at the names in the speculative grade loan index, about 45% of them are actually less than 1-time coverage. That's where the opportunity is going to come: smaller companies and value.
It's a gloomy conversation relative to what's on the screen. The S&P up by 1.8%. The Nasdaq absolutely ripping. Jared and Pete are going to stick with us. The S&P 500 up by around about 71 points right now. Coming up on this program, President Biden making his rounds at the G20.
I'm convinced we're going to come out of this crisis we've been through in the pandemic and other things stronger than we went in.
That conversation up next.
Is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
I'm convinced we're going to come out of this crisis we've been through in the pandemic and other things stronger than we went in. Every time we engage, we get better. And today we're focused on investing together and investing stronger than we have in the past.
President Biden meeting with world leaders at the G20 summit in Bali. His predecessor, Donald Trump, gearing up for another run at the White House, despite disappointing midterms, weakening his case for the Republican ticket.
Really do hope that President Trump sees the writing on the wall. He lost in 2020. We lost Georgia because of his behavior in the Senate race in 2020. That's a second loss. And then this year, the Republicans lost the Senate because the Trump-backed candidates in the Senate races were rejected by American voters. That's a three-time loser. And I'd like to think that the Republican Party is ready to move on from somebody who's been, for this party, a three-time loser.
Team coverage starts right now with Anne-Marie joining us from Bali. Emily Wilkins down in Washington, D.C. Emily, first to you, what can we expect from the former president later this evening?
Well, we are expecting Trump to announce that he will be running for president in 2024. Certainly, he still has a good amount of support within the Republican Party, but you are seeing party officials, folks in Congress, other Republican groups start to raise concerns and say, hey, this is a guy who has lost 3 times for us now. We need to start finding someone else. And you've also seen that in the halls of Congress here. You heard several Congress members say that they're a little hesitant on Trump right now. They want someone who can make sure that can deliver for the White House as well as Congress. And after Tuesday's really disappointing elections for Republicans, they didn't get nearly as many seats as they thought. They're not going to control the Senate, and they're only going to be able to control the House by such a small majority. And so that really is going to leave them looking for someone else in 2024. Of course, putting Trump now back in the spotlight means that we're going to have to start following him again, watching what he says. And some Republicans, they're just not ready at this point to sort of be responding to every single thing that Trump says and sort of contrasting their opinions against some of Trump's more controversial statements.
Hey, mate, you've been following the current president. We talked about this a little bit earlier this morning. The president left the United States a happier man. Is he going to return even happier?
He certainly is, Jonathan, when you see that the Democrats have now retained control of the Senate, regardless of what happens December 6th in Georgia. And Jonathan, I have to say, that's really on display here in Bali. I spoke to Admiral Kirby, and he says the president has the wind in his back. I just spoke with the president's Deputy National Security Advisor, Mike Pyle. He didn't want to delve too much into politics because he's an economics guy, but he said what foreign leaders see in the United States right now is a resilient economy, and the strength that President Biden has now, off the heels of these midterm elections, is the fact that they are now willing to listen to him, especially with open ears and open arms. And a third conversation I had was with the European Commission President Ursula von der Leyen, and I said to her, at the same time, you have a number of countries in Europe taking aim at the United States when it comes to the Inflation Reduction Act and what that means for subsidies for U.S. companies, when it comes to the U.S. putting these sweeping curbs on semiconductors to China. You have these issues with the United States. Isn't it all the same in terms of trade policy between Trump and Biden? And she insinuated she preferred working with the Biden administration.
Hey, mate, good to catch up. From Bali, Emily Wilkins down in D.C. to the both of you, fantastic, as always. Equity bulls got what they wanted in the last week. Gridlock, almost there. Downside surprise on CPI, last week got that. PPI this morning got that too. Earnings, Walmart, better than expected. And throw in a big buy back into the mix as well. Walmart in the pre-market up by more than 5% going into the opening bell. Jared, I wanted to come to you on that. And I know maybe you can't touch name-specific stuff, but just give me an idea of what you think when you see a name like Walmart outperform the way it has done. Is that good news or bad news?
It's been said too many times already, John, but the moment we're in right now is one in which I think good news really is bad news, because as we were discussing before, there are so many ways that the Fed can normally cause an economy to cool off and achieve a stable level. Today, unfortunately, it seems that the only way that the Fed will achieve its goal is by causing some meaningful unemployment. And so easier financial conditions, if the stock market rallies, if the bond market recovers, if companies find that their earnings are doing better, if retail sales remain strong, of course that's good news in the broad sense. But for the standpoint of markets and also for the standpoint of short-term economic equilibrium, you need to see, I think, unfortunately, a cooler labor market to have confidence over the next 1 to 2 years.
Governor Cook speaking right now, saying she wants the Fed to have a sustainably strong labor market. Peter, is that wishful thinking?
Well, there's what needs to happen in the near term, and then there's what needs to happen over the long term. And it's interesting when you speak to former Fed officials, or when one does, and you ask them, is there a place in policy for cyclical recession? It almost causes a short circuit of sorts, and they look at you and they sort of say, well, as policymakers, no, we never want to see a recession. But the fact of the matter is, recessions are part of the business cycle in capitalist economies and societies. And one of the things we're dealing with right now is this hubristic attitude that recessions can and should be prevented at all costs by the Monetary Policy Authority. I think that's sort of folly, frankly. And that leads eventually to, to quote Nassim Taleb, a more fragile marketplace for assets and a more fragile underlying economy. And I think that's what we're on the cusp of right now. And notwithstanding that we're talking about this with futures up 2.5+%, it doesn't change that.
What happens when we're all expecting the same thing? Neil Dutta of Renaissance Macro shared this with me a little bit earlier this morning. I think it's important to go through it with you both. He said recessions work through an element of surprise. What if recession has been widely expected but growth is picking up? He went on to say at the moment consumer spending is running 4% in real terms. What would you say back to that, Jared?
Well, it's true that consumer spending is up high, and I think the key question from an investment point of view is whose expectations? Because as we saw with the survey data earlier this morning, You can see in the market now, fund professionals, investment professionals have a certain set of expectations, but that's such a tiny sliver of the broader equity market and the economy as a whole. And it's the expectations, I think, across the broad economy and even across the broader investment landscape. Look at what household investors are doing, for example. They're not bearish. You haven't seen major outflows from the broad swath of American investors this year, something that you did see before prior market lows in 2009, after the dot-com bubble, even 2015 and 16. If we find a low in this market and rally to a new bull market over the next 5 to 10 years, it would be the first time in history that we would have gone through some tight conditions in a difficult period without seeing major outflows from investors. So I think the important thing to remember about expectations is whose expectations, how big a deal are they, and sometimes investment professionals overstate a little bit how important they are in the broader scheme of things.
Pete, final word. I'm almost laughing here, Jared. Final word, Pete, on that one.
But you know how much you love it when I answer your questions with a question, so I'm going to do it. When is the last time you have seen a consumer look at a full punch bowl and go, no, I've had enough? Happens every single time. The consumer spends until there's no punch in the punch bowl.
Peter Cicchini, Jared Woodard, to the both of you, going into the opening bout. This was so gloomy given where equity futures are, up by 1.6% on the S&P 500. Yields are lower, the dollar's weaker, we're down 5 basis points at the front end. On a 10-year, we're down about 5 basis points as well. Euro-dollar back to 104. Euro-dollar, lows of the year, end of September, 95.36. That's close to a 10% rally, just like that. Coming up, the morning calls and later, Joanne Feeney of Advisors Capital expecting Fed speakers to pour cold water all over markets. That conversation at the opening bell.
Consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Away from the opening bell, equities higher by 1.5% on the S&P. That's the price action. Let's get you some morning calls. First up, Jefferies initiating coverage on Harley-Davidson with an underperform rating, saying the stock's recent rally is overdone. Bank of America resuming its coverage on Netflix with a buy, seeing a stronger outlook for international subscriber growth. And finally, MoffettNathanson starting Amazon with an outperform rating, expecting further market share gains through 2023. That stock is up by 4.5%. Coming up, Walmart kicking off big retail results, topping estimates and boosting the outlook. More on that conversation with Joanne Feeney coming up.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio brings you continuing coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage continues only on Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Equity market bulls, your Santa rally came early. What a run we saw Thursday, Friday, paused Monday, picks up again on Tuesday. Equity futures up by 1.5% on the S&P, on the Nasdaq 100 up by 2.5%. The catalyst for this morning, we kick higher off the back of another downside surprise on inflation in America. This time, PPI, last week, CPI. Let's open and bow, switch to the board and get to the bond market. Treasuries look like this. Yields on a 10-year right now, down 3 or 4 basis points. We're off session lows, 381.62 on a 10-year. In the FX market, euro dollar, mentioned this briefly earlier in the hour. Cable, the pound against the US dollar, has gone from 103.50 at the end of September to about 119. Euro dollar has gone from about 95 to 104 in the same period. So we're talking about 9% moves on euro dollar and even more than that potentially on sterling. Unreal. Outside of that, crude 85.12, we're down 0.9%, and outside of that, there's only one stock on our radar right now. It's Walmart, and Walmart 30 seconds into the session is flying up more than 5%. With that story, here's Abby.
Hey John, yeah, Walmart is flying this morning. Its best day since the spring of 2020, but it's not just Walmart, it's also Home Depot, and the reason we want to bring in Home Depot is the contrast between these two reports. Now on the surface, Home Depot's report is okay, they beat. However, when you dig beneath the surface, unlike Walmart, their transaction prices were up about 9%, but foot traffic down 4%. That's not the right kind of detail that you want. Inventories also remain bloated, up 25%. They only held the outlook, which suggests they could miss the fourth quarter. Walmart, on the other hand, strong, strong, strong. They beat earnings by double digits. Sales also beat by 3.3%. Inventory bloat was halved, and they're also talking a strong game for the holiday season that folks will probably be out shopping. One question could be that if folks are going to Walmart more so because of the price being more attractive there, will it steal from other places? We don't know, but it's interesting, John, from a stock perspective, if we go into the Bloomberg terminal, it's very interesting because back in 2020, we've seen both staples and discretionary peak. The PE that we're looking at in blue, that is discretionary to staples coming in as, so interesting, John, what in white, real wages coming into a negative. So as Americans have less money to spend, discretionary's PE, it's still high, it's at 26 times forward, but it's coming in closer to staples.
Abby, great work as always, thank you. Walmart this year up by more than 5% on the session, on the year. I'll bring you the year to date as well, because compare this to the benchmark, the S&P 500 on the index, then compare the yearly performance of Walmart to what's happened with Amazon this year. Walmart's now just about positive for 2022. Amazon is down by 38%. Compare and contrast the fortunes right now. What we've heard from Walmart this morning to what you're hearing from Amazon at the moment. Amazon preparing its largest ever layoff, planning to cut 10,000 jobs. This coming after the tech giant's chairman warns of a recession coming.
The economy does not look great right now. Things are slowing down. You're seeing layoffs in many, many sectors of the economy. People are slowing down. The probabilities say if we're not in a recession right now, we're likely to be in one very soon. So my advice to people, whether they're small business owners or, is take some risk off the table.
Ed Ludlow joins us now on the West Coast for more. Morning, Ed.
Yeah, good morning, John. That softness in US producer prices clearly the catalyst across technology as the NASDAQ 100 pushes to its highest level since mid-September. You look at Amazon and Apple, the two biggest points drivers to the upside on that index, seeing tremendous gains in both of the stocks. Amazon perhaps feeling some read-through, some feel-good from what we saw in Walmart, given that a big part of that story is higher income spenders going into Walmart stores. Ahead of the holiday period, both the weaker PPI print and also the Walmart results might bode well for Amazon in the last 3 months of this year. The story, according to Bloomberg sources, is 10,000 jobs to be cut as soon as this week, according to sources. But context, this is less than 1% of its workforce. That chart tells the story. Higher energy and labor costs from an already bloated business really impacting Amazon, not just on the retail side, but its AWS in the form of margin erosion in the third quarter just gone. And this is what the street has been calling for, and therefore cheering as you see the stock push higher on news, not just of that soft inflation print, but also on the efforts to cut prices. Apple's another one that I am keeping a close eye on, John. The story here, they're going to be offering discounts of 8 to 10% for business customers who are buying up Macs. This is a rare move, a rare promotion from Apple. It's a different lever that they can pull right in the demand side when things are difficult at this end of the year. But again, that stock higher by 3%, caught up in this broad feel-good we see in the technology sector.
Losing your job before Christmas, just absolutely brutal. Ed, thank you, sir. Looking forward to the show a little bit later. Ed Ludlow from San Francisco. Joanne Feeney's got things to say. This is what she has to say. Market volatility reflects the eagerness to catch a recovery versus the fear that more rate increases must come for the Fed to control inflation. Expected dousing with a big bucket of cold water this week. Opportunities are growing, but patience will be required. Joanne joins us right now. Joanne, it's amazing because the Fed is pushing back. I heard that from Governor Waller in a massive way Sunday evening, but it's not shaping this market in a monster way in the way it used to. What do you make of how the market's responded to the Fed speaker the last couple of days?
Well, John, we've gotten a couple of data points that have really been encouraging. The lower CPI print, the lower PPI print than expected. The Fed clearly still has a lot more work to do, and we've seen these kind of rallies in the past over the last 9 months or so. And the Fed, speakers have been coming out and saying, hey, wait, don't discount the fact that we have a lot more work to do to get inflation under control. We're a very long way from that 2% target. And so, my concern is people should just be aware that there's a reasonable chance that some of the Fed speakers are going to come out and say, don't discount the fact there's a lot more work to do to bring inflation down. We're going to have to continue to raise rates, and we're going to be paying attention to the data. These are just 2 data points. There's a lot more work to be done from the Fed. And so just be a little cautious to expect, volatility to continue here.
Joanne, let's discuss how corporate America is handling some of these issues. We'll start with retail and then move over to big tech. The retailers that have reported so far, Home Depot, Walmart. Walmart's flying. I know you liked Target and TJX the last time we spoke. What are your thoughts on what's happening there now?
Yeah, no, what we're seeing, right, is that consumers are bifurcating. We have folks at the very high end of the income scale who really aren't affected very much by gas prices, food prices, small part of their budget. But in the middle and lower, right, clearly they're feeling the pinch from inflation. They're still in better shape in terms of their balance sheets. And so I think, one of the reasons why Walmart saw the increase in foot traffic and transactions is that, folks are shifting down to cheaper alternatives for retail and for food. Walmart has seen that increase in foot traffic. And I think for TJ Maxx and for Target, we're likely to see the same thing. They've all done a good job of clearing out the inventories of the more discretionary products that didn't sell well, and they're, holding more necessities. And, I think what we're going to see is, consumers shift from higher priced alternatives down to these bargain opportunities. And I think that's where Target and TJ Maxx really thrive. Plus, TJ Maxx is getting an inventory on the cheap as other retailers have to offload stuff that didn't sell very well.
The inventory piece of the story is massive for the inflation backdrop. It's fed goods disinflation, and you're starting to see that in the data, and BlackRock has picked up on that theme. Goods inflation is easing as it needed to, but the labor constraints driving wage growth and core inflation persist. So the Fed is still on a path to create a recession via policy over-tightening. BlackRock goes on to say, stocks aren't pricing that in, we stay underweight. Joanne, can you work with me there? Just how much work do we still need to do to bring expectations for earnings lower, down, and to what?
You know, clearly that we have a significant labor shortage in this country, and that is problematic for the pressure on wages, and that's a contributor to inflation, obviously. I don't think it's necessarily the case that we have to necessarily end up in a recession, but the job openings numbers are extremely high relative to folks looking for jobs, and so if we just see enough discouragement of economic activity to reduce job openings, that could take a lot of the pressure off of wages. But as you pointed out, Jonathan, the next shoe to drop may be further reductions in earnings expectations for next year, and that's something that reflects that consumer spending power in real terms is going to decline, even though their balance sheets are pretty strong. And that's I think the bigger concern now going forward as inflation numbers come off peak. The next question is, how much will earnings estimates for next year have to be reduced from where they are today?
Well, let's talk about it. They've come down a lot already. BlackRock say expect zero earnings growth next year. Are you alongside them? Do you expect it to be that bad?
Well, John, the way we like to look at it is look at the individual companies and individual sectors, right? Since we build portfolios out of individual stocks for clients, we don't have to own the whole market. And so that overall expectation, isn't as relevant to our selection. What we like to do is look in areas where growth can continue. Look at healthcare. Earnings there look very solid. They've actually been constrained by shortages, and those shortages are easing. So that's an area where you can still find growth. But in some of the places in software, for example, we could see more declines. In certain areas of retail, we would expect to see more declines, especially in the sort of mid to high-end retailers. So really, it's definitely a time for investors to be more selective, because overall, yes, we do agree that average earnings estimates will be coming down. Zero overall, perhaps even negative in some areas.
Joanne, let's pick one name. Amazon. A blend of two stories. The software story, cloud, and what's happening with e-commerce. Are the secular growth themes that people were so bullish about behind a name like this one, are they stronger than the cyclical test this company's going through right now?
Well, yeah. I mean, if you look at Amazon, clearly, they had to build a massive warehouse capacity. They had to really load up on labor in order to handle the increase in demand through the pandemic. Now what we're seeing is they're being pretty nimble. They're saying, okay, we're gonna offload a number of warehouses. We're gonna reduce that footprint. We're gonna scale back on the workers because we just don't need them anymore. We're seeing online sales as a percentage of total retail revert back to pre-pandemic levels. And we think that overall, though, when you look at Amazon as an opportunity in your portfolio, you really also have to look at how they're going to emerge from this with the cost cutting on the warehouse and labor side. And then that's going to point to a bigger share of their earnings coming from the cloud side, from Amazon Web Services. And that's an area where there's still a lot of growth ahead as companies continue to shift to the cloud, as more and more internet traffic pushes the demand for data handling and Amazon Web Services. So that's they have a dominant position there. It's profitable, and we think that's going to be a bigger share of valuation for the company going forward. So, we continue to think that Amazon is a good opportunity here, provided that you have a long enough term view to get through this retail cycle.
Stock is up this morning by 3.5%. Joanne Feeney, fantastic to catch up with you. The broader equity market up by 1.6% on the S&P 500, on the NASDAQ up by more than 2.3%. Coming up on this program, FTX spreading doubt right the way throughout the crypto industry.
If you're running a background check on somebody like Sam, you're not going to find anything. He's unblemished, if you will, prior to this incident.
That conversation up next.
top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues. We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Shown a balance sheet that may or may not be accurate, if you're being showed income statements that may or not be accurate, that are being validated by third parties, that's pretty rough. That's very hard to see through. If you're running a background check on somebody like Sam, you're not going to find anything. He was unblemished, if you will, prior to this incident.
The dramatic collapse of FTX wiping out roughly $200 billion in crypto market value. Blockchain CEO Peter Smith weighing in on the longer-term implications.
I don't think the institutional beta is actually going to fade here, but I do think it'll delay, the Wellingtons, the T. Rowe Prices, the truly enormous asset managers that you'd find in the equity space.
Team coverage begins right now with Ed Ludlow on the West Coast, alongside me here in New York, Bloomberg's Shanali Basak. Hey, Shanali.
John, you hear what the blockchain CEO had to say, blockchain.com, but you do see now Ken Griffin also telling Bloomberg, and I'm quoting him here, FTX is an absolute travesty in the history of financial markets. People are going to lose billions of dollars, and that undermines trust in all financial markets. Now, when we look at the Chapter 11 filings as they pertain to FTX, possibly more than 1 million creditors here are at play. In fact, there's so many creditors that they are trying to toss out the traditional rules of contacting the creditors by physical addresses and instead use customer email addresses. We'll know by November 18th the 50 largest creditors. There's also more at play here as new directors are named, and SBF himself posts a series of very cryptic tweets spelling out what happened is what he is asking. He also tweets out not legal advice, not financial advice. This is all as I remember it, but my memory might be faulty in parts. Now remember, other exchange executives are also testifying. You have Binance executives and Galaxy executives testifying just yesterday over in Europe. Galaxy executives saying this is less of a crypto issue and more of a governance issue, while you have Binance saying that they will submit evidence in regard to their pending acquisition that they had then since stepped back from, as well as that sale of FTT tokens that had led to a lot of the demise and the roll forward towards the bankruptcy.
I've got to say, given that people have lost lifetime earnings on that platform, It is shocking, the attitude he's taken out on Twitter recently. Ed Ludlow, this asset class still grappling with this loss.
Yeah, I mean, broadly, cryptocurrency is now rallying. Go on CRYP, Crypto on your Bloomberg terminal. You'll see a lot of green on the screen, and particularly some of the tokens associated with FTX and Sam Bankman-Fried, including Solana, which over a 48-hour basis continues to make gains. The main piece of news driving this is Binance saying that it plans to launch a crypto recovery fund that will help otherwise strong projects in the industry that are facing a liquidity squeeze. I think what's really interesting is focus on what happened here with the FTX token itself. Some analysis from Bloomberg Intelligence. FTX printed 169 million new FTT tokens, about $303 million worth, on November 13th, which inflated supply to the tune of 144%. There are some strange dynamics at work here, but ultimately, this is the root of what was happening here. The other piece of news overnight is not just that Binance will submit evidence to UK lawmakers on what their talks were to buy FTX, but also their decision-making behind selling out of the FTX token, the native token FTT. One final terminal chart, if I may, John, a sign of how quickly things changed. At the end of October, Bitcoin was less volatile than 99% of stocks on the S&P 500. Look at the bottom panel. Well, that changed pretty quickly, and a lot of the anxiety we've seen in markets stems from what has happened here. And I laugh because actually, to me, that is an astonishing chart, given how much we've assessed and analysed the relationship between risk assets over the last 12 months.
Ed, thank you, mate. We're going to leave it there. Shanali, I want to give you the final word. Leverage. Talk to me about leverage.
One thing that was interesting that Peter Schiff had said online in response to CZ's effort to the industry bailout fund is crypto is really the first shoe to drop. You had CZ, the Binance CEO, speaking to 40,000 people on Twitter yesterday saying that he didn't really take a lot of venture capital money. This all goes to say is this draws a lot of existential questions. Crypto or not crypto? Who do you take money from? At what price? And with what protections?
Unreal. Shanali, thank you. Wonderful work, and we're going to catch up with Shanali through the week on this, of course. I want to get to the broader market about 20 minutes into the session. The equity market's higher. The S&P 500 just off session highs, up by 1.35% on the S&P. On the Nasdaq, up by 2%. Into the bond market, yields lower, but off session lows again. So that move post PPI this morning, downside surprise on PPI. It fades a little bit. On a 2-year, we're down only 2 basis points to 436. On a 10-year, we're down 4 basis points to 381. The dollar weakness sticks for now, but euro dollar gives up 104. 103.93 is where we are on euro dollar right now. On that currency pair on the session, euro dollar is just about positive still, but by 6 or 7 tenths of 1%. Let's break down this equity market from the top, lift the lid on the index, and get you some sector price action. Here's Abby with more.
Hey, John. Well, that weaker dollar and yields down, well, that, of course, does have stocks up on the day, maybe off the highs, but nonetheless up 1.4%. And not surprisingly, all 11 S&P 500 sectors are higher. Now, the big mega cap tech sectors, those are the ones leading: tech, communication services, and discretionary. As you've been saying all year, yields down, tech stocks up, but tech stocks up in a big, big way. But even materials and energy are higher too. Now, I really want to show something that's outrageous because these are big gains, but China Tech, John, over the last 4 days, it is up an incredible 24%. Well, at this point, 23%, but still a huge gain for 4 days. And this, of course, has to do with the positive developments out of China, including the property save, lowering the COVID zero policy, and then what seems to be a positive meeting between President Biden and President Xi. When we break it down further, this is helping out the chip space. We have the stocks trading higher by more than 3%. Some of those components, NVIDIA and AMD, up sharply on the hope, perhaps, that maybe some of the tensions between the U.S. and China around chips will fade. And then there is Alibaba and JD.com. China Tech back up, John. If you bought KWeb 4 days ago, you'd be up 25%.
Wow, what a rally it's been. Abby, thank you. Not just China Tech, the Hang Seng more broadly in Hong Kong has ripped as well. The DAX could finish today in a bull market. The equity benchmark in Frankfurt, Germany. What a turnaround it's been in European markets more recently. We heard from the Philadelphia Fed President, Patrick Harker, just moments ago. We've been talking about crypto. This is what he had to say. I do not see the crypto market posing financial stability risk. He went on to say that Congress must decide which regulator oversees crypto. On the inflation backdrop, which some of you might be more interested in, Patrick Harker did a speech last week on inflation. He said, up like a rocket and down like a feather. This is what he had to say about inflation this morning. The Fed can keep inflation expectations anchored. One thing we don't talk much about and should is balance sheet policy. What's going to happen with QT? He said the balance sheet belongs on the back burner as a policy tool. Let's see if that remains on a back burner going into 2023. Coming up, more Fed speak still to come. I'll bring you the trading diary live from New York this morning. Good morning to you all. Your equity market rally resumes on the S&P 500 at 1.4%. This is Bloomberg.
Of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
The tensions over Taiwan to come to blows or to come to any kind of conflict. Nothing's changed about our policy. We're obviously going to continue to support Taiwan's self-defense, but we still adhere to a one China policy. So there's no reason for this. And we want to see the tensions across the strait to be solved peacefully and no change in the status quo by force or unilaterally. And the president was very firm about that yesterday.
We're taking out some of the heat in the conversation between China and the United States. Contributing to the overwhelmingly bullish theme of the last week. Things are getting better seemingly for some of you. CPI, downside surprise. PPI, downside surprise. Equities up by 1.5% on the S&P. On the Nasdaq, up by more than 2%. That's the price action. Let's get you the trading diary. Coming up, the Fed Vice Chair for Supervision, Michael Barr, testifying on Capitol Hill at the top of the hour. Retail sales and a host of Fed speak coming up on Wednesday. Williams and Barr speaking once again. Plus, President Biden meeting with UK Prime Minister Rishi Sunak at the G20. Looking forward to that. Another round of claims on Thursday as well, and more Fed speak. Bullard, Bowman, Mester, Jefferson, and Kashgari all on deck. From New York City, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari-sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2007,